Where markets are right now is maybe you could say in the easier phase of the optimism curve when no policy change has yet been implemented, and so kind of all options are still on the table.
When you look at the layers of promises, which would grow the debt, complicated policies like tariffs, this is not going to be an easy situation.
The market is front-running economic announcements.
The reality is you may get a lot more fiscal stimulus before the end of this year.
Policy error probably is our biggest risk, whether it be from the administration or whether it be from the Federal Reserve.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming off the back of the biggest one-week loss on the S&P 500 in more than 2 months. Equity futures attempted to bounce back, up by 0.1% on the S&P. On the Nasdaq 100, we're up by 0.5%. The Nasdaq last week down every single trading day, a 5-day losing streak. Going into this week ahead, tons of earnings. You'll hear from Walmart, you'll hear from Target, but the big one for the Nasdaq 100, you'll hear from Nvidia on Wednesday. That's the big earnings report. Right now, the eyes of Wall Street on a battle royale in Palm Beach. Kicking it all off over the weekend, money managers from Dan Loeb to Kyle Bass throwing their support to Scott Bessent, triggering this response from Elon Musk. Business as usual under Scott Bessent or real change under Howard Lutnick. Reporting over the weekend on this issue, our very own Anne-Marie. AMH, where is this race?
So the tension in Palm Beach is spilling out, as you see, onto Twitter, and that has caused, obviously, some unnervousness when it comes to the former president and potentially and the president-elect on who he's going to choose for this top job, which means now, because the tension is so high between Howard Lutnick and Scott Bessent, that they're expanding the search. We're hearing other names now, like Kevin Warsh, like Mark Rowan of Apollo, like Senator Haggerty back in the mix. Scott Bessent is still there, and they are looking for potentially an off-ramp for Howard Lutnick.
So there's a fascinating paradigm right now, which is essentially pitting the idea of shaking everything up, Elon Musk's basically tearing up the status quo, and people like Kyle Bass, like some of these other big finance heads coming out and saying the market has chosen. The market will prefer Scott Bessent, and what we understand right now is we're getting a real test of whether the market is the ultimate test for Donald Trump and his policy.
Just how sensitive will Donald Trump be to equity markets this time around? I used to call this the presidential put or the Trump put. Are we finding out if it's not the likes of Scott Bessent that they go in a different direction, that his sensitivity has shifted somewhat? And I think that's a really important question as we wait for this decision.
Also this morning, Wall Street Journal editorial board, I'm sure President-elect Donald Trump will be looking at this. They're saying Donald Trump's cabinet nominees so far reveal a desire to disrupt Washington, and disruption is needed in many places. But as he mulls his choices for Treasury in the economic policy post, the question markets will ask is whether he will disrupt the policy mix that was successful in the first term. And you can see other names coming to light. We've reported last night for NEC, potentially Peter Navarro is in the mix. So you have these two camps of those that are a bit more traditional, want to be a little bit more judicious when it comes to tariffs, and those that want to go really blanket tariffs day one, 60% on China, 10% around the United States.
Let's sit on the first term. I actually thought the approach to the first term was highly effective. You have sort of a marketing role in the NEC, the National Economic Council. The director at that time was Larry Kudlow, fantastic salesman. Then you have someone a little bit more sophisticated, a little bit more quiet, someone that can actually work diplomatically with some of your allies to get where you want to be in a Treasury. And that was Stephen Mnuchin. Now, if you're going to do this time around, do you want the guy who's a little bit louder to be over at the NEC? Who might that be? A Howard Lutnick. And you'd want someone a bit more thoughtful, sophisticated, a Scott Bessent over at Treasury. And that's why a lot of people thought that was the direction of travel until the last week.
Peter Scheer of Academy Securities put it really well. He put out a note over the weekend saying 3D chess or 52-card pickup. Is there basically some sort of cohesive strategy here? Or is this basically giving cabinet positions to all the people who helped out and basically payback for loyalty? And that ultimately is one key question for markets that have taken about 60% of the post-election euphoria out of markets. And you've seen that real pullback. And certainly we saw that last week.
This is the individual that's got to oversee a $28 trillion bond market. This is the bond price action right now. Lisa, since we last spoke, your 10-year yield is a whole lot higher. Just short of 450 right now. We breached that level on Friday for the first time since May, but yields are higher by 2 basis points on a session. Bramo, 446.
Yeah, basically, you had a whole host of issues while it was gone, including better than expected retail sales, in particular the revisions, in particular some of the inflation on the PPI side, but then some of the Fed speak, where suddenly it seems like different Fed officials, led by Chair Powell himself, seems amenable to not cutting rates as quickly as they were before, that they're concerned about some of the better than expected economic data. There also is this feeling that the sequencing of Trump's policies may not be that favorable to the bond market. Either way, you've retraced most of your gains, and what you're seeing is a real rethinking of just how low these rates can go.
The 2-year this morning up by a single basis point. The 2-year yield, 4.31. Coming up this hour, we'll catch up with Steve Major of HSBC with the bond market in a 2-month slump. Terry Haines of Pangaea Policy on the search for Trump's Treasury Secretary, and Gilles Moec of AXA on Europe's complicated position. We begin this hour with stocks coming off their worst week in more than 2 months. 10-year Treasury yield steadying after topping 4.5% for the first time since May. Stephen Major of HSBC adjusting his outlook. We shift our 2025 10-year Treasury forecast to 350, reflecting uncertainty over the floor. The reversal of the summer rally looks overdone, so we keep the near-term conviction at bullish. Steve joins us now for more. Steve, my friend, welcome to the programme. Let's start with that near-term bullish call. At a time where a lot of people are bearish on the bond market, give us a reason to be bullish.
Well, it's all about the forwards and what's priced in, John. And we've spent the last 2 months pricing in what's just happened. It's no longer an uncertainty in terms of who's going to win the election, is it? So in fact, we've probably removed some of the uncertainty from a few months ago, in my opinion. We actually know who the president's going to be next year. But as you were saying in the prelude just there, the sequencing of these policies is still a bit uncertain. The only thing that we've got to really go on is the valuations, and markets are priced for a much higher equilibrium rate than the Fed's been indicating, so 4% or more for the longer run equilibrium. And in the recent piece that you referred to, I gamed out a scenario whereby the Fed even reversed its rate cuts of this year. Now, I'm not saying that's our baseline, it's not our forecast at all, but I'm just saying to try and game out what the yield should be, you have to imagine a scenario whereby the Fed gets really hawkish rather than just pausing. And I think that if that was to happen, and it's unlikely, but if it was to happen, it's the front end that is the most mispriced, not the back end. So the 10-year yields look at a decent level to me, and probably a good entry point for bond investors.
Steve, could we talk about the back end just a little bit more? There is plenty of discussion about the prospect of increased supply, more deficit spending. You've written about this a million times. I know your thoughts on the subject have evolved over the last few years. How do you think about supply and its influence on price in the bond market?
Well, you know very well that I think that the idea that you can look at the future supply and say that the yield will go up or down doesn't make a lot of sense. You mentioned $28 trillion. That's the free float of bonds these days. On Trump 1.0 back in 2016, it was about half of that. So the stock has doubled, but I don't really see how that has driven the bond yield. Today's bond yield is about the policy rate and expectations for the policy rate, full stop. Now, every dealing room in the world has to deal with concessions around auctions and syndications, but that should not be confused with a strategic view on bonds. So there is a term premium factored into the long end, and that's about the supply-demand potential imbalance. But it's priced in, John. And I think that the risk is some people could be double counting that term premium.
Steve, what strikes me, what's unique about your view is some degree of conviction. I was reading a whole host of year-ahead outlooks over the weekend, and there's very little conviction. Morgan Stanley had a range on the S&P from 4,600 to 7,400 with the possibility of, some sort of hot reacceleration of inflation or potentially stagflation. What gives you the certainty that on a longer-term trajectory, whether it's supply or whether it's just even the possibility of growth that exceeds expectations, that long end is pegged, that you could see yields come in?
Yeah. Look, there's no certainty around anything. These are scenarios and they're probability weighted. My point is we're priced for strong growth and additional term premium. So, for example, long-dated forward real yields above 2%. That's above the trend GDP. Now, it could be that all these policies mean that we should be looking at a much higher trend GDP, but the FOMC hasn't changed their view on that yet. And frankly, I doubt it. I think it's more plausible to be talking about a sugar rush than it is to be talking about an upward shift in the trend. If you think about the aggregate of the policies, the aggregate, some of them will give, some of them will take. I doubt that the longer run trend is being revised up. And for that reason, I will stress that longer run real yields are above that trend, and in that case, investors are protected. They garner some risk premium by receiving long end securities.
What I thought was interesting about your note, Steve, is that I think about your call over the past 10 years, and you've been the perennial bond bull, and you've mostly been right, except that we've been in sort of this new regime that's causing a lot of people to question whether yields can continue to go lower. I'm just wondering, what makes you think that this time is not different, with the fact that you've got yields rising around the world, where you have Japan suddenly not becoming that sort of peg in negative yield land, when you have the idea of even potentially Germany engaging in fiscal expansion?
Yeah, there's some very good points there, and you're introducing the global angle to the forecasts, and thank you for that. Look, over the last decade or so, we've also had neutral calls. We haven't always been full flat out bullish the whole time. So I think that whilst I might be badged to something regarding my view, we are quite tactical as well. It's true, on balance, we tend to be more bullish than bearish. But the global point is well made. You introduced the idea that Japan could be contributing a different impulse to yields in the future. Maybe Japanese investors won't buy treasuries as much. Maybe they're going to repatriate. But that's all possible. But at the same time, we have to take into account what's happening in China and what's happening in Europe. To me, it's pretty unambiguous that the longer run equilibrium rates, the R stars, if you like, for China and Europe have been going down. And therefore, it makes it difficult for me to see how the US can be so exceptional. These rates tend to be co-integrated. So yeah, you can always find an anecdote or a particular region that says that something might change. But it's on aggregate, Lisa. I think the China and Europe contribution to the global rates call is unambiguously pulling yields down.
Stephen, when it comes to this exceptionalism with the United States and this idea of policy impacting the bond market, how concerned are you about the fact that before we even get to policy, we don't have the personnel, and we see a messy transition when it comes to appointing the top post at the Treasury Department?
Yeah, Anne-Marie, that's an important point. We're just sitting here. In some regards, we are speculating. We don't know who the people are. We don't know what the policies are. We're not going to know for a few months. And so it's completely rational for the Fed and economists in general to say we're waiting and we're watching the data. Now, if you do that, if you wait and watch the data, you've got the potential in the next 3 months, before you don't have any certainty about the policies, of things softening up. Today's bond yields are caught in this trap whereby they've been pulled higher by putting a heavy weighting on the no landing and Trump 2.0 scenario. And they're not really reflecting the fact that hard landing is a possibility for 2025. Just the fact that people have stopped talking about it hasn't actually shifted the probability. So in the coming months, whilst we're all waiting on the data and waiting on the personnel, there's a lot that could happen. And I'm not going to say what the event will be because I frankly don't know. It's just about probabilities, and that's how bond markets work. The bonds are priced as if everything's going to be perfect and all the policies are going to be on the hawkish end of the range, and therefore bullish for the stock market and bearish for the bond market. I think we've had a couple of months pricing that in already.
Steve, it's good to hear from you, sir. As always, Stephen Major there of HSBC with a lot to chew over. Andrew Honhorst of Citi echoing some of this stuff, saying just last week markets are underestimating labour market weakness and Lisa overestimating the inflationary effects of upcoming tariffs and fiscal policy.
Especially because what we've heard over the past couple of weeks from members of the House and members of the Senate who are Republicans is you need to offset some of the tax cuts and other plans with potentially cuts elsewhere. This isn't about some sort of fiscal impulse, and there does seem to be restraint. So on that level, it's not necessarily going to be another fiscal expansion with at least lip service being given to some restraint.
If you are just joining us, welcome to the programme. Equity futures right now on the S&P up by about 0.1%. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. T-Mobile is the latest victim of a cyber attack. The company reported its network was breached by Chinese hackers in an attack on multiple telecom companies. U.S. officials said the hackers infiltrated the networks in an attempt to steal customer call records and compromise communications belonging to a limited number of people in government and politics. That includes President-elect Donald Trump. A report from The Information says that NVIDIA has asked its suppliers to change the design of its server racks for its new Blackwell chips because of an overheating problem. Shares down 2% in the pre-market. The changes to the chip came late in the production process, but the chip giant hasn't told customers of a production delay in the chips. NVIDIA reports earnings post-market on Wednesday. And the widely anticipated fight between Jake Paul and Mike Tyson may have failed to live up to the hype, but that didn't stop it from surpassing expectations from a ratings standpoint. Netflix reported an audience of 65 million viewers. That rivaled some of the world's most watched sporting events. Still, many viewers took to social media to air frustrations around glitchy and buffering streams. The 27-year-old Paul easily beat the 58-year-old Tyson after 8 rounds. Paul took home a $40 million paycheck. For Tyson, it was $20 million. And that's your brief, John.
Absolutely ridiculous numbers. Danny, thank you. Up next on the program, Besson versus Lutnick.
In Trump 1.0, we had non-inflationary growth.
You're going to have the possibility of balancing the budget of the United States of America at the end of his term.
The race for Treasury Secretary getting just a little bit chaotic. That conversation up next from New York City this morning. Good morning. Equity futures on the S&P 500 firmer here by 0.1%. A little bit of a lift again on bond yields up 2 basis points. Let's call it 4.46. Under surveillance this morning, Besson versus Lutnick.
In Trump 1.0, we got a demand shock from the private sector fueled by the tax cuts. And that was met with deregulation, and that's why we had non-inflationary growth.
You're going to have the possibility of balancing the budget the United States of America at the end of his term. No nonsense. It can happen because he's focused on not wasting the vast waste that is our budget.
So here's the latest. The battle to be the next Treasury Secretary intensifying over the weekend as money managers Dan Loeb and Carl Bass took to X to advocate for Scott Besson before Elon Musk replied that Besson would be business as usual, while Howard Lutnick would actually enact change. Trump has appeared frustrated with the infighting, and staff are now looking for alternatives, including former Fed Governor Kevin Walsh and Apollo's Mark Rowan. Joining us now to discuss is Terry Haines of Pangaea Policy. Terry, let's dive right into this mess. What's your base case for who gets this nod now?
Oh, goodness, I have no idea. I'm just going to follow Anne-Marie's reporting and see where we go. You know, I wrote about this 18 hours ago, and I said, you know, everybody on the street's convinced it's Besson or Lutnick, but last week you couldn't have gotten a bet on Gates or Hegseth or Gabbard or, you know, so, you know, I don't think anybody knows, frankly.
Is the lack of a Treasury pick in itself a drag on markets? The fact that this tension brewing in Palm Beach is actually now bleeding into the Twitter sphere?
Yeah, I think in 2 ways, actually, Anne-Marie. I mean, one of them is that, you know, I mean, first of all, you know, these staffers all need to remember who got elected president, and it's none of them. And, you know, it doesn't serve their principal, President-elect Trump, very well at all for them to be going out in public. It makes them all look bad, including Trump. So that needs to stop. Beyond that, you've got all it does is actually stoke continued uncertainty about what the policy is actually going to be going forward, number one. Number two, one of the things that Trump has done last week is made this pick more important by the nominations of people like Gates and Hegseth and Gabbard and even Bob Kennedy for other things. I mean, it emphasizes that they need to get the Treasury pick right, the economic team pick right, because there's a lot of head scratching and concern in markets about the picks that seem kind of not up to the task.
Terry, I always say personnel is policy, but in your latest note, you disagree. And I'm curious to know why.
Well, I'm not disagreeing with you really per se. What I'm really doing is suggesting that that process is policy as much or more than anything else. You got a situation where the markets were thinking a week ago, well, we're going to install person X into this position and that's going to drive policy. Well, not so much. And you saw big reminders of that just the last few days from the Senate, where the Senate said, look, we're going to take this very seriously. We're going to do our jobs. We're going to vet these nominees. And essentially the consistent message from the Senate is going to be, we're going to do our work. Nobody's going to get a free pass, and we're going to see where this goes. That means Trump doesn't exactly get who he wants. So there's process right there, number one. Number two, on taxes, for example, the degree to which the Senate can agree on a deficit number and markets can be okay with it is a whole lot more important. That those set parameters. That process sets parameters in ways that Trump, frankly, can't affect. And then the Senate and the Congress generally is much more important on the specifics of tax policy than the president will be, precisely for that reason.
You mentioned the Senate, so I think of their advise and consent role. But do you think there's any appetite in the Senate right now to give Trump recess appointments?
Oh, I don't think so. I think not even a little bit. And I think that's what you heard from people like John Thune, people like Shelley Moore Capito in the last few days. I saw Mark Wayne Mullen on one of the Senator Mullen of Oklahoma on one of the Sunday shows saying exactly the same thing, that the Senate would do its work to properly vet and properly figure out whether these nominees were qualified and whether they could be installed with no difficulty. That's the Senate saying we're going to do our job. I don't even want to hear about recess appointments.
That said, Terry, I guess if you take holistically the appointments so far, as well as, frankly, the squabble over who's going to be Treasury Secretary, there's a real question about whether some of the campaign promises by Donald Trump are truly what he wants to see implemented when it comes to things like tariffs, when it comes to immigration policy, when it comes to energy policy. From what we're seeing right now, is that your sense? That basically he's making good on some of these policies, and that, frankly, with the Treasury Secretary, we're going to see a greater emphasis, perhaps, on tariffs than some of the other issues that people were looking for?
I thought you all made valid points on the top of the show, but I'm on Team Lisa this morning on kind of the most valid points because I thought you really summarized it very well. But what you get here, I think, is a classic old style fight between whether or not when Trump says fix it, whether or not he's going to prioritize the really important stuff that's going to define his presidency, things like debt and deficit, defense, managing and lessening geopolitical risk. Or whether we're going to have fights over whether or not we're going to have deck chairs on the luxury liner, or whether we're going to throw them overboard. Kind of the fight about the size of government, that kind of stuff. This is the time in administrations where any incoming group will say, "Yeah, we can handle all this. It'll be really good, et cetera, et cetera." But they're going to have to prioritize really quickly. What you get out of the last 2 weeks, I think, is that they haven't begun to make up their mind. Trump particularly hasn't been begun to make up his mind, and that's bad for markets, I think.
Hey, Terry, appreciate your time, sir, and your thoughts. Terry Haines there of Pangaea Policy. This got messy over the weekend, and largely because Howard Lutnick has pulled a little bit of a Dick Cheney as well with this particular position overseeing the transition simultaneously.
As we said last week, this is supposed to be the producer. He's the co-head of the transition team. And at the last moment, you throw your name into the ring, and then you want to become the star. When you're supposed to be vetting the candidates, like a Scott Bessent, like a Matt Gaetz, to take on the roles. You're supposed to be guiding the president-elect on who you should be putting in those roles. And then all of a sudden, it becomes a fight because you want the role yourself.
The race continues. Exclusive reporting from Anne-Marie throughout this morning on that race. Coming up next on the programme, the G20 summit kicking off in Rio. We'll catch up with Bloomberg's David Gura. From New York City this morning, good morning to you all. Equity futures on the S&P attempting to bounce. We're higher by 0.1%. Five-day losing streak on the Nasdaq 100, the longest daily losing streak since the start of the year, going all the way back to January. This is your bounce. We're up 0.4% on the Nasdaq. Going into the big one, earnings from Nvidia on Wednesday. Equity futures on the S&P just about unchanged following the biggest weekly loss since the start of September. In a bond market, the two-year yield up and away for 4 straight weeks. Yields are higher this morning by not even a basis point. The 2-year at 4.3077. Just this drip feed of better economic data, stickier inflation, just weighing, starting to erode the Fed's easing bias.
What I thought was interesting, the Citi U.S. Economic Surprise Index now at the highest level going back to February. This sort of drip feed of that index climbing higher, even as the likes of, say, Europe and that surprise index ticks a bit lower. Fed Chair Powell saying the key words last week, which was that the economy was not sending any signal that we need to be in a hurry to lower rates. And that reset the bar for next month's rate cut or not that we might get from the Federal Reserve.
Does it set up a December pause? CPI December 11th, payrolls December 6th. With those higher yields, a stronger US dollar. Check out euro dollar this morning. The dollar, 7 straight weeks, Lisa. 7 straight weeks of strength for DXY.
And there's a real question of why it should change and how many people came out over the past, say, week talking about parity as being a likely call with respect to the euro versus the dollar. Key question that I have is how much are we overestimating what the ECB is going to do to offset some of what we're seeing in the U.S., right? Are they going to cut more aggressively in response to tariffs, or are they going to try to hold on to a bit more, a little bit more strength? Strength is the wrong word for the euro, to basically retain some of the value.
Euro dollar, 105.38. I'm not sure strength, strong, or anything like that is being used to describe Europe right now. Under surveillance this morning, the search for Donald Trump's Treasury Secretary continues to heat up. Money managers Dan Loeb and Carl Bass advocating for Scott Bessent, with Elon Musk backing Howard Lutnick. Former Fed Governor Kevin Warsh and Apollo's Mark Rowan also emerging as contenders. Anne-Marie and the team reporting on this story throughout the weekend.
Yeah, so I was basically on the phone the entire weekend, phone blowing up, because the mess that is around this pick is starting to really unnerve a lot of people, including the president-elect. He appears frustrated that there's now become this fight between Howard Lutnick and Scott Bessent. Someone described it to me as a knife fight, and it feels like it was Howard Lutnick, the first one to really draw the knife. Now the issue is, because the president-elect is annoyed with this tension, they're starting to expand the search. My question is, are they expanding the search so Howard Lutnick could gracefully accept something else? Because Scott Bessent is still in the running. And I know that Howard Lutnick, according to my sources, they're preparing potentially to offer him a very fancy, exciting ambassadorship, say this Court of St. James. Or is this really a new search? And are we going to be talking about a dark horse candidate that suddenly emerges by the end of the week?
So based on your reporting and what I read elsewhere, including from the Financial Times, tariff seems to be at the epicenter of all of this right now, at least from the market standpoint. And this is where it can get a little bit messy for the transition team. I think a lot of people in the market now believe there is a huge amount of information contained in whoever he selects for this appointment. And if you end up with a Bessent or an Apollo, Rowan, good friend of this program over the years, you end up in a situation where the market believes, OK, they care about financial markets. If you go with a Lighthizer or a Lutnick, I think this market turns around and says, OK, I think we understand the priorities now. It's tariffs.
And that's basically what different hedge fund managers have been saying to the Trump campaign. If you want the markets to be on your side with this, if you want to see that run, put in the place of Treasury Secretary someone like Scott Bessent. Here's the interesting aspect, though. Is there a signal in all the names that are actually the front runners, all being people who'd be market friendly except for Howard Lutnick? Right? I mean, is that something that tells you where the emphasis is on and that Howard Lutnick might be the outlier versus, say, a Mark Rowan, a Kevin Warsh, or a Scott Bessent?
Or do they potentially balance this with the NEC role. So I have reporting as well from last night with Saleha and Josh Green that Peter Navarro is in the mix for the top job at NEC. This was an individual that was drafting the executive order for the president to come out and remove the United States from NAFTA. The markets pushed back on this. And then there was a phone call between Mexico, Canada, the United States, and instead of removing themselves from NAFTA, they said, okay, we're going to renegotiate a new deal. But this individual is now being considered to be in the West Wing, and maybe that's a balance for someone that Wall Street likes at Treasury.
We do have one pick. Donald Trump nominating Chris Wright over the weekend as Energy Secretary. Wright runs a Colorado-based oil and natural gas fracking services company. He's a vocal proponent of oil and gas and has downplayed the threat of climate change. Talk about working out what the priorities are. Pretty clear on this front over the weekend.
And Bloomberg Intelligence coming out saying he could be positive for U.S. shale. This is someone who has a huge fracking U.S. oil and services industry. I was not surprised at all about this individual because why? About 24, 48 hours before he was announced, Harold Hamm, a huge donor to the Trump world, said this was his number one pick, Chris Wright. And I think it was obvious the direction of travel on the campaign trail where the transition team was going when it came to the energy position.
What's fascinating is how much this sets up a divide between the shale producers as well as some of the big oil. Exxon and Chevron and some of the others who are committed to the U.S. staying in the Paris Climate Accord and who've actually committed to all sorts of green energy offsets. And then you have the likes of Chris Wright coming out and basically saying that's ridiculous and being much more of a climate change skeptic. This is a fascinating paradigm at a time where it's not clear how much the policies are going to be good for all oil players in the United States.
I don't know Chris Wright. I've never met Chris Wright. But based on the comments that I've seen from that individual, strikes me as he's very pragmatic about the energy needs, the requirements of not just the United States, but the world, and seems putting far more emphasis on energy poverty and what's actually required to lift people out of poverty, which is fossil fuels and energy, whether people like it or not. And that's where the emphasis is for me this morning off the back of this appointment.
If that's the case, I think a lot of people would agree. I mean, it's interesting. When I was in Peru talking to a different number of producers, one of the key questions was how much energy is necessary for whether it's the AI adoption or whether it is lifting people out of poverty. It's a question of how you get there. And it's a question of whether it is mandated by the government or whether it's mandated just by simply the market. And I think that that's really going to be the big divide. Do some of the oil majors stick to some of their promises if some of the necessities of some of the requirements are lifted because it is economically advantageous to be investing in renewables?
The energy ministry also plays this key role in making sure these projects for liquefying natural gas get done. Something President Biden put a pause on and something Trump promised to undo. And I think that's something you could see really be undone within the first few days of this administration. He's also going to be added to a new energy council alongside Doug Burgum, which, by the way, was the only person on my bingo card that has gotten a job that I thought was going to get a job.
Yeah, I think we've seen some surprises over the last week, that's for sure. I want to turn to this development. It's a big one in the last 24 hours. The United States lifting some restrictions on Ukraine's use of Western-made weapons, authorizing long-range missile strikes on Russian territory. The Biden administration looking to bolster Ukrainian President Volodymyr Zelensky's position before Trump takes office in January.
So this is now given the red light to something that Zelensky has been begging, but it's going to be measures. There's going to be restrictions on how far Ukraine can go when it comes to these missiles. The issue is, of course, that we saw bombardment over the weekend of Russia attacks on Ukraine, especially when it comes to energy infrastructure. Zelensky, though, said, words are words. I'll believe it when I see missiles.
Well, to me, the big question is how much is this trying to be preventative of further missile attacks? How much is this to seize more land before some sort of deal is negotiated by Donald Trump that basically says to Russia, you can keep whatever land you're basically taking, that you've taken over? And how much is this coming now because China is annoyed that North Korean troops are in Russia and might not necessarily get involved, so it might not widen in the same way that it would have? A lot of really interesting questions that this raises.
This has got to be a big focal point, the G20. David Gura joins us now from Rio, where world leaders are gathering. David, welcome to the programme. We know that President Biden has met with Xi. We know that he went to the Amazon over the weekend. But the eyes of the world, I think, again, shifting back to Ukraine and a decision that this White House has made over the weekend. How much of a focal point is that this week?
We know that it's scuttled a lot of conversations that are happening on the sidelines here. And I should say, going into this summit, I talked to Ben Rhodes, who is a senior foreign policy advisor to President Obama, who was here at a moment of transition in 2016 at the G20 when Donald Trump was coming into office. And he cautioned me against looking too much at sort of how these foreign leaders are thinking about what a second Trump term is going to be like, and instead watch how they're moving to sort of interact with each other and think about how global alliances are going to change. But to your question about Ukraine, it looms large here, and it's kind of fascinating the way in which it does. Yes, we've had this development over the weekend, but you look at who's here and who's not, and President Putin declined to come here. He thought that his presence here would be more of a distraction than anything fruitful. And then in the weeks leading up to this summit, you had Vladimir Zelensky really lobbying hard, petitioning President Lula to sort of invite him here, make him a guest of the summit. In fact, that didn't happen. That request for an invitation went unrequited. So, at a summit like this, the goal at the end is to get to some form of agreement, to come to terms on this communique or statement that all of the parties involved agree on. The weirdness of the G20 is unlike the G7, where you're talking about a group of allies. The G20 is not that. You have countries that are frankly not allied with the United States here as well and making their opinions known. So we know that over the course of today and tomorrow, John, it's going to be these kind of fraught conversations on the sidelines in these bilateral meetings where I think the conflict in the Middle East is going to loom large, and indeed what's happening in Ukraine is as well.
Well, speaking of the conflict of the Middle East, Saudi Crown Prince Mohammed bin Salman decided to cancel his trip to the G20. Reportedly, this has to do with something medically wrong, an ear condition. But David, honestly, is this just basically world leaders deciding to skip this G20 because it doesn't really matter? It's an exit interview for President Biden, and the individual they really need to speak to is sitting in Palm Beach.
I think that's absolutely right. I mean, yes, this is important because there are some new faces here that I think some world leaders want to get to know. So Keir Starmer is coming here, of course, from the United Kingdom, and has a host, as we understand it, of bilateral meetings, including one with President Xi this morning that's going to take place here in Rio. But I think you're right. This is a swan song for the current president, and somebody who, over the course of his long career in politics, has really advanced the cause of multilateralism, this kind of dialogue. And suffice to say, it doesn't seem like that's as in vogue as it used to be, and certainly isn't going to be in just a few months here. So I think they're trying to figure out what the future looks like, again, sort of what their alliances are going to be like and how they're going to change. But to your point about the action being in Palm Beach in South Florida, we've seen a number of leaders here either stopping on their way to Rio in Florida or planning to go there afterward, President Milei of Argentina among them. They know that going forward, that's going to be the person who's going to be the real change maker, the person with whom they're going to have to deal, the person who they're going to have to figure out sort of how he's thinking about issues of trade and just sort of broader alliances and geopolitics. So there are open questions about that. I think they're trying to firm up sort of their thinking on that and get a better sense of sort of his sensibilities going forward.
David, when it comes to probably the most important bilateral relationship for everyone in the world is between China and the United States, the world's two biggest economies. What did we learn from that meeting between Xi Jinping and Biden in terms of China's priorities looking into 2025?
So I'll start with what President Biden said on the sidelines of that meeting, that he was very quick to say that he's improved that relationship. There is now open dialogue, more open dialogue between Washington and Beijing. He sort of sees that as an achievement. There was kind of some sorrow, I think, in the way that he spoke about the relationship. He underlined its importance, but kind of nodded to the fact that all that he's done to try to bring that frosty relationship back to life could change on a dime when Donald Trump returns to the White House. Look, you listen to what President Xi had to say around that meeting as well. It was a forceful statement. He kind of nodded to the fact that he thinks it's in the world's interest for these two superpowers to have a cordial relationship with one another. Dialogue is good. Friendly competition is good as well. But he drew these red lines when it comes to trade and democracy, things that he sees as things about which China would fight back if they needed to. So he's taking a position as well here, again, going into this moment of transition globally, where you have Donald Trump returning to the White House. China, of course, will not sit idly by, making known the fact that China is prepared to fight back if Donald Trump follows through. And what he promised over and over again on the campaign trail and since, that kind of economic war that he's waged against China would only deepen when he comes back to power.
David, how much is China already fighting back in the sense that they're taking advantage of the policy uncertainty in Washington, D.C., the lack of clarity around what Donald Trump's priorities are going to be, and going aggressively after trying to be the champion of free trade, however ironic that may be, and try to bolster their relationship in places like South America and, frankly, around the world?
You were in Peru last week. I'm in Brazil this week. I think it's really evident to me, as I'm sure it was to you, just the role that China is playing when it comes to development financing and philanthropy, kind of infusing a lot of money into this continent and so many others around the world. It is trying to wield a lot of influence in the developing world. I talked about sort of the diminished role of President Biden at this summit. President Xi has a much sort of more formal kind of front and center role here, and a lot of countries are trying to meet with him as well. So I think we're seeing that transition underway. I don't want to make it seem like that's something that's happened overnight. And going back to what we were just talking about, sort of the role that China has been playing here in South America, this is a long game for China, but I think it's kind of coming to fruition at this point, and sort of it's kind of established itself as another pillar on the global scene, kind of making inroads economically and developmentally here in South America and in other nations around the world.
Sitting here wondering when I get to go to Latin America as well. David, thank you. David Gura in Brazil, Lisa back from Peru. I'm sitting here still in New York.
Oh, do you want to go to Peru? You want to have some ceviche?
Go to Peru.
Is that what's going on?
Yeah, sure, why not?
Big corn kernels.
Yes.
I love those.
Oh, did you enjoy yourself over the last week?
Great food.
Sounds
really
like you might have done. Okay. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Hundreds of HSBC managers have been asked to reapply to keep their jobs. People familiar say the interviews are already underway for HSBC's newly formed corporate and institutional banking division. Senior staff are competing with each other for jobs at the new division. Job cuts are expected to be announced in the next couple of weeks. And Morgan Stanley strategist Mike Wilson, known for his bearish views on U.S. equities, has surprised Wall Street with a bullish outlook for 2025. The strategist expects the S&P to end the year at 6,500 points, with gains driven by economic growth and more Fed cuts. He previously had a 5,400 target for mid-2025. The new outlook, though, that is calling for an 11% gain from the current levels. Warner Brothers Discovery has settled its lawsuit with the NBA after it lost its decades-old broadcast rights to broadcast games. The TNT and Max owner will be allowed international NBA rights in parts of Northern Europe and Latin America. Additionally, the company will continue to produce its flagship studio show Inside the NBA, hosted by Ernie Johnson, Charles Barkley, and Shaquille O'Neal. The show will be licensed to Disney to be aired during ESPN coverage of certain NBA games. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Europe under pressure.
If you look at the good, the bad, and the ugly of the global economy, unfortunately, Europe is in the ugly. Cyclically, they're challenged. Secularly, they're challenged. These dynamics today mean that if you're lagging, you are likely to lag even more.
How much more? That conversation up next. The highway to the danger zone, HSBC, that danger zone for equities, 450 on a 10-year. Right now, your 10-year, 446. Equities just about unchanged. Under surveillance this morning, Europe under pressure.
If you look at the good, the bad, and the ugly of the global economy, unfortunately, Europe is in the ugly. Cyclically, they're challenged. Secularly, they're challenged. There is no definitive political leadership in the two countries where you need it most, Germany and France. These dynamics today mean that if you're lagging, you are likely to lag even more. It wouldn't surprise me if you see that differential go higher. It wouldn't surprise me if you see the euro go weaker.
So here's the latest. The outlook for Europe's economy looking bleak following Donald Trump's election win, with the region bracing for a potential trade war. Gilles Moec of AXA Group writing the Eurozone will find itself in a complicated position. We think the ECB will need to look through a not entirely spotless short-term outlook for inflation and engage in a more forceful restriction removal path. Gilles joins us now for more. Gilles, welcome to the programme. Everyone on this show over the last week overwhelmingly bearish on Europe. Can we just start here before we get into what the ECB needs to do? What could go right for Europe over the next 12 months?
What could go right? Well, the positive thing is that wage growth now exceeds inflation, which means that if households are not completely obsessed with building up more savings, there could be some additional consumer spending. That's a possibility. Another thing that could go right is that instead of the massive trade war which we are bracing ourselves against, there could be a sort of more benign stance coming from Washington D.C. and as an economy that is reliant on exports, Europe could do okay. But that really is it, because otherwise most of the engines of growth are switched off at the moment.
So given that, Gilles, do you think that the negativity is warranted and that maybe not even enough is baked into the outlook for the euro as well as for the European region?
Well, for me, the euro and the outlook for the European region are two different things. And to some extent, they could move in different directions in the sense that a weaker euro is definitely what Europe needs right now. If we need to deal with tariffs on European products in the US, if we need to deal with slower traction from China, heightened competition from Chinese products on third markets, then a weakening of the currency is definitely what is needed to avoid that our outlook, which is already quite mediocre, doesn't get worse. And I think we have ingredients for that, because the sort of signals that we can perceive from the ECB right now is that they are taking the measure of the downside risks, and there has been a very clear change of tone from Frankfurt in the last few weeks.
Okay, so Gilles, if you're saying that basically this is a region that needs a weaker euro, how weak is necessary in order to get some of the exporting engine back into gear?
Well, if you look at what we used to have as sort of a reaction function, if you think that we're going to end up with a 10% tariff on European products entering the US, usually you kind of offset half of it with the currency depreciation. So you probably need another 5% decline in the currency. Some of it is probably already priced, but what the market is talking about right now, which is moving to parity, is something which probably makes sense.
When it comes to how Trump was going to deal with Europe, we do know that he does like to deal with nations on a bilateral basis, not this multilateral basis. So maybe he won't deal with the European Union as a whole, but he'll go country to country. Who is best placed to deal with Donald Trump?
On this, I would use a phrase that Jay Powell used himself: not permitted under the law. Trade policy in Europe is a European matter. I know it may sound strange to non-Europeans, but the treaty is pretty clear on that. I understand why it would be tempting for foreign governments to try to negotiate bilateral deals with Germany or France or whatever, trying to work on their perceived weaknesses and their various interests. But down the road, on anything of any kind of magnitude, you need to deal with Brussels. The treaty are perfectly clear on this. And for instance, if there was a decision to try to leverage on the US capacity often to move Berlin in a certain direction, we've seen, for instance, that Germany has opposed the European Commission's decision to levy retaliatory tariffs against China. It did not change anything. The tariffs on China moved. So you can actually get into a conversation with national governments, but if those national governments cannot actually build a coalition around themselves, then it's not necessarily followed through in Brussels. So it may not be actually the right solution for anyone trying to negotiate with Brussels.
Gilles, just taking a step back and listening to your theory, I just wonder why European bonds aren't a screaming buy right now. If essentially you think a weaker euro is the way to go, you think that fiscal thawing in Germany is overstated, they're not going to really engage in any kind of big stimulus, why wouldn't people just go headlong into long European bonds? Because guess what? Those yields are probably going lower.
No, I agree. I think we've probably reached a point at which it's going to be quite tempting, because the risks to growth are on the downside. The risks to inflation now are on the downside, even if the data has not been absolutely pure on that front. There is going to be probably some overall restriction in the supply of bonds next year relative to what we would have had in a BAU situation. So yes, probably we're going to see a correction in long-term yields in Europe, especially if, as I expect, the ECB is increasingly clear about the path. They've been cutting rates, But I think they need to move to another step, and I think they will, which would be to engage in forward guidance, which would be to clearly steer the markets towards a proper cut and large cut in interest rates.
Gilles, appreciate your time, sir. Gilles Moec there of AXA on the shift that's required from this European Central Bank. Up next on the programme, Amanda Lynam of BlackRock, Henrietta Treyz of Veda Partners, Francisco Blanch of Bank of America, and Kate McShane of Goldman Sachs. From New York, the second hour of Bloomberg Surveillance. Up next.
In the background, you've had a lot of these macroeconomic uncertainties be resolved.
We think the inflation problem really is in the rearview mirror.
We're skeptical as to whether or not the Fed is going to be able to carry on cutting interest rates.
One of the things I really don't want to see is a 50 basis point rate cut. If that's happening, we're wrong on the fundamental story and the growth story.
The problem has not been the Fed for the economy. The problem has been the Fed and the way the market has been pricing it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and here are your scores. Equity futures on the S&P 500 attempted to bounce by not even 0.1%. The Nasdaq 100 on a 5-day losing streak up by 0.5. On a Russell, we're up by 0.3. Your week ahead dominated by earnings, including from retail, Walmart and Target. The big one coming from Nvidia. The big one for this market right now, though, Game of Thrones. Down in Palm Beach. Let's talk about the names, shall we? Howard Lutnick, Scott Bessent. We've also heard it's going to be the likes of Kevin Walsh, Senator Haggerty in the race. He's going to join us tomorrow morning. Looking forward to that conversation. The list is getting longer.
Yeah, at a time when a lot of people are looking as this is sort of the linchpin of what the priority is in the Trump administration. Is it tariffs, or is it some sort of strong American, strong dollar, or is it weak dollar? What kind of policy are they actually looking for at a time when the other picks don't give a lot of clarity about the overarching priority from this administration?
What is so peculiar is why are we having a Game of Thrones episode when it comes to the Treasury pick? President-elect Donald Trump ran on an economy pitch. This is most dearly, probably closest to his heart. So why didn't he come out almost immediately with the economic team first? The source of the tension, according to my reporting, has to do with Howard Lutnick. He's the co-chair of the transition. He's the producer. Now he wants to be the star, putting his name in the ring for Treasury. And that's become the source of a lot of tension between him and Scott Bessent, who's this key advisor for President-elect. So now, given the tension has becoming not just within Palm Beach, but bleeding out into the social media space, on Twitter this weekend with Kyle Bass, with Elon Musk, they're starting to expand the search for other names.
Did you see the walkout into Madison Square Garden?
I did.
See that over the weekend. I think the one thing we both noticed, none of those candidates were there.
None of those candidates were there. Potentially, Howard Lutnick was there, except there was no photos of him and there was no images of him. I was told that he was on the plane, but he was not in that now infamous photo of them all, having McDonald's. He wasn't there, and he wasn't in the walkout to MSG.
Speaker Johnson doesn't strike me as a kind of UFC guy, does he?
My favorite is it's sort of this exercise in cool. Who's going to be the first buddy? Who's going to be the person who's going to be sitting next to him at UFC? I mean, we're going to do this again, and this is what markets are focused on.
I woke up Sunday feeling like I kind of missed out, that we should have gone to Madison Square Garden.
Is that right? Did you feel like you would have walked out and had
Atmosphere looked amazing.
Feeling cool?
Atmosphere looked amazing. I'm not sure they want me to walk out with them, but the atmosphere looked amazing. Equity futures right now on the S&P up by 0.1%. Coming up this hour, we'll catch up with Amanda Lynam of BlackRock on a 2-month bond slump. We'll speak to Henrietta Treyz of Veda Partners on the next Treasury Secretary, and Francisco Blanch of Bank of America on energy under Trump's White House. We begin this hour with stocks lower and yields mostly flat after reaching their highest level in 6 months on Friday as investors weigh the Fed's next move. Amanda Lynam of BlackRock saying uncertainty around the path for monetary policy in 2025 is elevated, while not our current base case, a re-acceleration of inflationary pressures materializing from potential fiscal and/or trade-related policies following the US election could cause the Fed's terminal rate to land higher. Amanda joins us now for more. Amanda, good morning. It's good to see you.
Good morning. Thank you for having me.
It's only a few months ago we were talking about the Fed getting ahead of the curve to insulate the labour market, and maybe they needed to get accommodative. And now we're back to a word that you use in your work, which is normalising, except normal might be a whole lot closer to where we are than we thought a month ago.
Right. And I think that distinction between normalizing and easing is really important. We would not be surprised for the Fed funds terminal rate to land somewhere around 4. But again, the drivers of that are really important. If that is because growth is holding up really well, that is something that the credit market can really digest. If that is because inflation is reaccelerating and there's a lot yet to be seen on the policies that are coming down the pike, we have some clarity, but the path is very wide in terms of potential outcomes. That would be a much less supportive outcome for credit, especially if it's coupled with slower growth. I think the bigger risk for corporate credit is what we're characterizing as a disorderly sell-off in Treasury yields. If we have a gradual backup in Treasury yields, again, because of good growth, that is actually a tailwind for credit because it brings in yield-based buying. If it's disorderly, feels spooky, then it's coming back to the fall of 2023 when I think that would give investors some pause.
Can you define disorderly and how orderly things are at the moment?
When we chat with market participants, that 4.60 level is really the area at which they become concerned. I think if you start to see the velocity of that back up really be swift, so I'm talking about gaps of 15, 20 basis points in a day for a consecutive period of time, and again, not driven by positive growth surprises, but more driven by some downside risks on the policy side or upside risks on the inflation side. That's, I think, where we would start to be a bit concerned, because then if you're a yield-based investor, you may come to the conclusion that it just waits to deploy capital into corporate credit, and that yield-based demand has been incredibly strong. In the context of all of this kind of path dependency, as you know, credit spreads have made news cycle tights, and so that tug of war between spreads and yields is very much still in place.
John asked the key question,
yes.
Right? What constitutes a disorderly move in yields at a time where 15, 20 basis point moves are something we have seen? This isn't abnormal, and there's a question of whether they have to stick for a longer period of time. I mean, let's say Howard Lutnick gets chosen as Treasury Secretary, and people view this as really an endorsement of stronger tariffs at the outset before some of the other tax cuts or other pro-growth types of implementations. Do you foresee that type of disorderly move in Treasury yields?
That sequencing really does matter. I think leaving some of the candidates to the side, if you have a situation where you have upward pressure on inflation, and I think what really concerns us is not so much the targeted tariffs, but the across-the-board tariffs that could spike retaliation, because then you're moving from a discussion of the one-time price level argument that's been floated, which I'm not necessarily sure I agree with is not that disruptive to the market. But if you have kind of retaliatory tariffs back and forth, then you actually have pressures feeding on themselves on the inflationary front. And I think it becomes much less certain. We kind of take a step back and say, okay, well, where do we go from here? We like building in floating rate exposure to portfolios. We like financials because they would not be exposed to the same degree on tariffs because they're more of a services-based sector. We like domestic-facing companies, actually. So ironically and somewhat counterintuitively, that may bode better for high yield and leveraged loans because they tend to be more U.S.-focused as opposed to multinationals. And financials are really important. Financials are 33% of the IG index, and they're still trading wide to non-financials. And so if we think that they can tighten, that can actually pull index-level spreads even tighter than where they are now.
There's a larger question, and John and Anne-Marie were focusing on this last week, about at a certain point, if you see the companies out there as being in pretty good shape from the U.S. and continuing to be so, could you see spreads narrow to such a degree that even investment-grade companies trade within Treasury yields?
Yeah. So I think you had a conversation last week on this with Brian Weinstein, which I thought was great. Look, I think there is scope for spreads to move tighter. I do not see a world where en masse, triple B corporates are trading tight to the sovereign. But you do have some AA and a few AAA companies still left outstanding in the corporate credit sphere that are trading really close. I mean, the spreads to treasuries are in the single digits for some of those bonds at the moment, depending on where they're priced to. I think the net here of everything is that corporate credit is in a pretty good place. It all boils down to growth. If we have a supportive growth backdrop, I would say manageable tariff risk, and then I would say the continuation of yield-based support plus some favorable technicals, that's a recipe where credit can stay in its current tight range or even move slightly tighter. I think waiting for a significant catalyst for spread widening in credit would really involve a combination of persistent upward pressure on inflation, a slowdown in growth, and again, that disorderly sell-off, which it does feel like the volatility of the bond market has been elevated relative to what we've been used to in past cycles. But I think it would really be that kind of 460 range where folks get concerned up to the 5% range that would catch our attention.
Amanda, just talking about this disorderly bond sell-off, I'm thinking about how disorderly this Treasury pick has come to be. And if you talk about the real impact of tariffs, what I'm hearing from sources that Peter Navarro is really in the mix, this trade skeptic at NEC. And Howard Lutnick, who's come on and talked about the fact that you should use tariffs, is more of a yes man to Donald Trump. The real tariff man would be someone like Robert Lighthizer, who already worked for him. What would a Lighthizer at Treasury, Peter Navarro at NEC, mean for this bond market?
Well, again, leaving the specific individuals aside, I think the issue that we have to come to grips with is what does this mean for kind of ongoing upward pressure on inflation? And really the worst case scenario for credit is kind of an across the board tariff that is also coupled with retaliatory tariffs that provides kind of upward pressure on inflation that corporates can't manage. Right. And I think that's the key, is that if corporates are feeling that they have significant cost input pressures that they are not able to manage through, then you get to this situation where right now corporates have just been hoarding labor and they haven't been laying off. If you get to a point where corporates need to use the layoff tool to protect their margins, that's where I think we really start to get concerned, because that's when you could have the weakness in the consumer extend beyond the lower income segment.
Is the fact that the transition when it comes to the top post for financial markets already seems chaotic and it is messy based off every phone call I had over the weekend, is that already a market negative?
I don't think so. I think what we're really bracing for is for this to play out over the next couple of months. I mean, even heading into the election, we were not expecting ultimate clarity once we knew the outcome of the White House, the Senate, and the House. We know that this is, I mean, you've been saying it, personnel is policy, right? So we've been watching for these appointments. I think we're expecting this to be a longer term trend. The Fed has even said as much, that they're not even reacting to policies once they're implemented. They're actually more poised to react to policies once you see the economic impact, which will take some time. So I think this is going to be a drawn-out event actually into 2025.
That said, I'm glad that you brought the Fed into this, because that's been the other big shift over the past week, is that some of the rhetoric out of Fed officials has been talking about how they can afford to wait. Yeah. They don't have to cut rates as quickly. How much is that a game changer on certain levels, that there isn't the same kind of dovish bias that there might have been, say, a couple weeks ago?
So I was a little surprised at the market reaction last week, because a lot of what Chair Powell said, he also said during the November 7th press conference, in terms of we may slow the pace, we're not in a rush. I think our base case is really that there will be a cut in December, a 25 basis point cut in December. As you noted, though, at the start, the path becomes much more tricky into 2025. It all boils down, though, Lisa, to kind of what you're alluding to, which if they're not cutting because growth is above trend, which we still are tracking above trend, that is a backdrop that corporate credit and I think risk assets broadly can manage. If they are not cutting because they are concerned, to Anne-Marie's point, about upward pressure on inflation or disruptions in supply chains, that sort of thing that would cause inflationary pressures, that's another issue. But they are also focused on growth. I think it's not a foregone conclusion that tariffs could cause them to not cut or even hike, because there could be a growth impact that they are focused on as well.
We could see some major changes. Amanda, it's good to see you. Appreciate your time. Amanda Lynam there of BlackRock on financial markets. It's good news that the president-elect has taken his time with a really important decision. And I think we should all bear in mind it's only been 2 weeks. It's not even been 2 weeks since the presidential election. That aside, when we use words like messy and chaotic, I think it's important to identify why we're using those words this morning. It's not because of the president-elect. It's because of the co-chair of the transition throwing their own name into the hat to ultimately try and become the Treasury Secretary. That's where the chaos, if there is any, has come from.
And now it's bled on social media, with Elon Musk coming out, the first self-proclaimed first buddy who seems to be attached to the hip of President-elect Donald Trump, at Mar-a-Lago all the time, at UFC over the weekend, came out in support of Howard Lutnick. This is something, this tension, that President-elect Donald Trump would like to keep in the family. And I think the fact that it's spreading beyond the gates of Mar-a-Lago is what is unnerving them. And it is why they're now saying, if we cannot keep this in the house between these two men, we're going to have to look elsewhere.
The race continues with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Spirit Airlines has filed for Chapter 11 bankruptcy after competition from rival carriers and its failed merger with JetBlue put pressure on the budget carrier. According to the filing, its listed assets and liabilities are between $1 and $10 billion. Spirit had reached an agreement on broad debt restructuring with a majority of its loyalty and convertible bondholders. Federal contractors should expect massive cuts in the president-elect's efficiency drive. Vivek Ramaswamy made that comment on Fox News over the weekend. The billionaire is leading the efficiency task force with Elon Musk. He added, quote, "There is massive waste, fraud, and abuse right now. We expect certain agencies to be deleted outright." In sports, the Steelers held off the Ravens in a matchup of two of the AFC's top teams. Pittsburgh pulled off the win without scoring a single touchdown, thanks to kicker Chris Boswell going 6 for 6 on field goals. The win marks the Steelers' 8th over Baltimore in their last 9 matchups. Elsewhere, the Chiefs' undefeated season has come to an end after a loss in Buffalo yesterday. Bills QB Josh Allen ran for 26-yard touchdown on the 4th and 2 to seal the win for the Bills, who improved their record to 9-2. And that's your brief, John.
Danny, thank you. Have you noticed the Trump dance going down in college football and NFL? How long before the joyless NFL ban the Trump dance?
Oh, you think that's the case? Oh, really? You're going to really get on top of celebrations? Come on, it's about sportsmanship.
They're getting on top of celebrations all the time.
I know they do. That's what I'm saying. It's not about the Trump dance, but it's okay.
The Trump dance was all over social media at the UFC event as well.
I saw. The joyless NFL. Up next on the program, the fight for the top job in the Treasury.
They need to get, the Treasury pick right, the economic team pick right, because there's a lot of head scratching and concern in markets about the picks that seem kind of not up to the task.
Don't you prefer the over-the-top elaborate celebrations?
I actually do. And my favorite part is when they try to celebrate without really seeming like they're celebrating, so that they can't be cracked down. Does this count?
That's beautiful.
Thank you.
Unfortunately, you're not on camera right now. We're looking at a beautiful New York City. From New York this morning, good morning. Equity futures right now on the S&P 500 firmer by not even 0.1%. But check this out in the bond market. We resume the climb. Yields are higher by 3 basis points. The 10-year 4.47. Under surveillance this morning, the fight for the top job in the Treasury.
These staffers all need to remember who got elected president, and it's none of them. It doesn't serve their principal, President-elect Trump, very well at all for them to be going out in public. They need to get the Treasury pick right, the economic team pick right, because there's a lot of head scratching and concern in markets about the picks that seem kind of not up to the task.
So here's the latest this morning. The eyes of Wall Street on a battle royale playing out in Palm Beach, Florida. The race to become the next Treasury Secretary between Scott Bessent and Howard Lutnick reaching boiling point over the weekend. President-elect Donald Trump said to be losing patience with infighting, leaving staff to widen their search. Alternatives now including Apollo's Mark Rowan and former Fed Governor Kevin Warsh. Henrietta Treyz of Veda Partners joins us now for more. So Henrietta, the big question, where is this one going?
Well, I think the most important decision really is about what happens with Robert Lighthizer, as you guys have been mentioning. I think there's very limited amounts that the Treasury Secretary is going to do in terms of writing tax bill with Congress. This isn't the first time around where we're crafting it out of thin air. That tax bill is going to be written by the Senate Finance Committee staff, the Chairman Mike Crapo, and the House Ways and Means Committee and their staff. And the Treasury Secretary is going to be influential to the street. But in terms of these massive pieces of legislation, it's tariffs and taxes. And I'm really more concentrated on where Bob Lighthizer is going to go than whether it's Scott Bessent or somebody else at Treasury right now.
Well, Henrietta, according to my sources, Robert Lighthizer is still in the mix, as well as Senator Haggerty when it comes to Treasury. What would a Robert Lighthizer at the helm of Treasury mean?
What I'm wondering is whether he's going to do something in the trade czar universe. That seems to be the main theme of the Trump cabinet pick so far, whether it's the government efficiency initiative, which has sort of an efficiency czar, crypto czar, or Bob Lighthizer in a role that's more like a trade czar. He doesn't even need to be at Treasury. I think it's pretty unlikely that he would land at Treasury. I think the president-elect is enjoying this process of having a big fight for the transition. We definitely saw this last time around as well, so I don't think it should come as a surprise. But sort of a roving czar that has authority over USTR, the Department of Commerce, and Treasury is going to be much more important, in my opinion, than Treasury Secretary itself.
When you read the tea leaves, though, and you see that potentially, and sources are telling me that the team is trying to maybe give this off-ramp to Howard Lutnick, offer him a fancy first world-class ambassadorship. Potentially, then that would lead the way for either Scott Bessent to come up and get the nod, or they're going to expand the search because this is just becoming a little bit too messy between these two men. How do you read the tea leaves right now? And do you think there's going to be a timeline when we can get this nod?
Yeah, I think the Trump transition folks and people that I've spoken to who are working with them, they're trying to get as many names as possible. Specifically, we know that they're trying to get CEOs, somebody that comes with quite a bit of stature to come and fill that role already. They have not been able to find that particular human yet. And so we're still in the realm of the Scott Bessent, Howard Lutnick's component. I think Bessent probably for the most part has been out on the street the most, meeting with, big bulge bracket banks and hedge funds, talking about a very sort of slow, phased in 5% a month increase in tariff rates. Those are the kind of things that I think when the details come out will spook folks. When it comes to the transition, the president-elect has actually moved very quickly. I would expect the Treasury Secretary to be somebody that's confirmed within the first 2 weeks, let's say, in January. So they want to get somebody that's actually able to get through, not a Matt Gaetz-like candidate who's going to run into some serious ethical problems.
Right. When it comes to the Senate, obviously we think maybe the Treasury post could sail through. But you said the president-elect was moving quickly. Why is it taking him so long when it comes to Treasury? This is one area where he's not moving quickly, even though he ran on an economic agenda.
Right. And there's not just a clear loyalist that he's planning to place. Some of the others, whether it's a Tulsi Gabbard or an RFK Jr., were overtly on the campaign trail. In this situation, the folks that would have been in that role have already said that they do not want to take on the position. When you hear things like, going through the ethics component and the background check is preclusive, which I believe Scott Bessent said a couple weeks ago, it gives you an understanding of just how difficult it is to make the decision for these folks to go through the ringer with the FBI, with background checks, with the disarming of their funds and really understanding where that needs to go. So I think there's a lot of personal decisions that go into Treasury in this role that are maybe a little bit higher bar than the Attorney General pick, for example.
Henrietta, how much do you see this as a test almost of how important the market response will be to Trump policies as sort of the ultimate check?
Well, I think the street is very heartened by the fact that they feel like they're playing a role in this. I mean, every single meeting I go to, investors think that the stock market, whether it's going up or down, has a real leash on the president. I don't think that that's true, just to put it bluntly, but it's definitely a view on the street that they have a say in what the Trump administration does and specifically how Donald Trump responds. So they're very optimistic, for example, in the bond markets that should his tax bill and tariffs go into effect in the same year, it's my expectation tariffs will go on in the first 4 or 5 months and the tax bill be passed in December, July at the earliest, you're going to get these massive both inflationary and deficit finance pictures. And what I hear often is the bond market's going to send a message and stop that. That's just not the way that DC typically works. They are much more concentrated on, quarter over quarter GDP growth, unemployment rates. The president-elect has tweeted quite a bit about the stock market, but that's never led him to not impose tariffs, as we all remember from 2018 and 2019.
That said, Henrietta, we did hear from Mike Johnson, House Speaker, that there was going to be some sort of offset to any tax cuts. We heard from French Hill when he was on with us a couple of weeks ago that he's really going to be careful about not necessarily expanding the budget too much. Why do you think that ultimately that the market does not play the role that it thinks it does?
Well, first of all, it's not what Congress is watching. A tax bill is in existence for 4, 5, 6 years, 7 in the case of the last package. That's not, designed to boost the market on a day-over-day basis. President-elect Trump is going to be at the very beginning of his term, which is 4 years. Not every single day matters. It's just sort of a fundamental misunderstanding of how D.C. watches the U.S. economy and the stock market in general. And while I think President-elect Trump tweets about it, as I mentioned, it's very different than writing and crafting legislative policy that will increase the deficit by at least $2 trillion next year, whether the bond market responds or not. That's what it's going to take. That's what it costs. So when you talk about the government efficiency initiative, what I hear as a former budget staffer is really exactly the wish list that we get from an administration on the first Monday in February. You get the budget every year. It's very optimistic and wishful thinking. It includes a lot of offsets to offset the cost of the spending that you want to roll out. But ultimately, very little of that actually gets effectuated. So when I hear the president and Elon Musk and Vivek Ramaswamy talk about government efficiency, what I hear is this is the thing that we'd like to do in a perfect world. It will not actually happen, but it's part of the conversation that's necessary to mitigate the appearance of deficit increases on the magnitude of $2 trillion, if not more, just to pass the existing tax rate.
We'll see. Henrietta, it's good to see you. Henrietta Treyz there of Veda Partners. The philosophy has shifted. In Trump's first term, the focus was on reciprocity, leveling the playing field. In the first term of Joe Biden, in his presidency, it was about national securities objectives and protecting industry. This time around, it feels like it's changed for Trump's second term. This time around, it feels like they're looking at trade as a source of revenue to offset tax cuts. And it's the relationship between the two that's worthy of more attention.
He's talked a lot about that. And to your point, Jonathan, the fact that there was this Trump put in Trump 1.0, does the bond market now become even more important for him this time around?
The conversation will continue. Coming up next on this program, we'll talk energy with Francisco Blanch of Bank of America from New York. This is Bloomberg. Two-day losing streak on the S&P 500. Here's your bounce this morning. We're higher by not even 0.1% on the Nasdaq 100, a 5-day slide, bouncing back by 1/3% on the Nasdaq. The Nasdaq down every single trading day through last week. In the bond market, breaching 450 for the first time since May in Friday's session. The 10-year getting closer to doing that all over again. Yields higher by 3 basis points. Lisa, 10s at 447.
There's the positive upside surprises that we've seen from economic data. There's also some rhetoric from Fed officials talking about how they might not have to cut as quickly. And then there's a question around policy and what the sequencing is going to be. All of this leaves a very jittery bond market. And the economic data points this week of NVIDIA, Deere earnings, as well as Target and Walmart, to me, it might be the most important data points that we get. Because if you get strong retail earnings from, say, Walmart, what do you get in the bond market? Does that lead to a 455?
Just going to reinforce U.S. exceptionalism all over again. At whose detriment? Europe's. That's whose detriment. Euro dollar right now sliding back to 105.40. Off session highs. Europe not in a good place. Luis de Guindos, the ECB vice president, saying risks have shifted from inflation to growth. And haven't they just?
Yeah, and Gilles Moec actually talking about how this is a region that needs a weaker euro in order to really get some of the growth that they're looking for. Talking about how just on the tariff proposals alone, you could see the euro depreciate to about 5%. To about parity, and that actually being necessary. It all leaves this question of where is the off-ramp? Has this all been priced in? Are people overpricing some of the pessimism, or is this just about right given some of the projections?
The next ECB meeting, December 12th. Under surveillance this morning, investors awaiting Donald Trump's Treasury Secretary pick. Money managers Dan Loeb and Carl Bass advocating for Scott Bessent, with Elon Musk backing Howard Lutnick. Former Fed Governor Kevin Warsh and Apollo's Mark Rowan also emerging as contenders. Lots of chopping and changing through the weekend.
Absolutely. This weekend, you really saw the tension that has been building in Palm Beach spread into the Twitter sphere. You have a number of market participants coming out and saying they're going to back this individual or not. And that is what seems to have nerved President-elect Donald Trump, and why the staff is looking at maybe there's other names we should throw into this ring. What I have a question for is whether or not Howard Lutnick, I'm told potentially they're looking at another place for him. If he is to accept, say, an ambassadorship, does that mean that can quell some of this tension and Scott Bessent can rise to the role? Or are they really going to start from the drawing board once again and start interviewing fresh candidates?
There's a real larger question here, too. And I think that Peter Scheer of Academy Securities put it well. I mentioned this earlier, 3D chess or a 52-card pickup. I hated 52-card pickup. I always kind of resented anyone who suggested it. But there's this question of whether there is some sort of cohesive plan here about getting an agenda through, or whether it's really kind of just payback to different people who have really contributed to the campaign. That's the question mark in markets, and the reason why maybe you've seen some of the post-election euphoria fade, just because there is this lack of certainty about what's real and what was just simply lip service.
Even when you were a kid, were you throwing cards at people saying, let's talk about the deficit? I don't want to play games.
No, people would throw cards and I'd say, I don't want to talk about that. I want to talk about the bond market.
Let's talk about the bond market. House Speaker Mike Johnson, don't throw cards at us, saying that Congress will, quote, do the math to make sure President-elect Donald Trump and his plan to end tax on tips is enacted. Johnson pledging to swiftly advance Trump's economic agenda once the newly elected Congress is in place. Once again, and we go back to a point we made about 10 minutes ago, the connection between what happens on trade and what happens here is important.
Right, because you want to use tariffs as revenue raising, then you can put into your legislation, as these are the pay-fors for the Oprah Winfrey of taxes that Donald Trump had promised on the campaign trail, expanding the child tax credit, no tax on tip, exemptions for Social Security taxes. The list went on, 50% corporate income, corporate tax rate, except there's going to be obviously some sort of nuance that if your production's made in the United States. The list goes on. What Speaker Johnson, though, is saying is that you can't have everything without, quote, doing the math, without having the pay first. Although I do wonder, is this something he directly spoke to President-elect Donald Trump about maybe this weekend when, they were walking out into MSG?
Well, with this, there's also the issue of how much will Congress act as a check on Donald Trump? How much is this going to really be a pushback where, say, Matt Gaetz isn't going to get through, as Henrietta Treyz was saying? Or are you going to say basically that Trump has a clutch over Congress and can be able to get through some of his proposals pretty clearly? And that's a real question mark when it comes to some of the other fiscal proposals as well, where there'll be pushback saying we are worried about the deficit.
Wouldn't that be the most Elisa thing ever? Ringside seats, and she's trying to talk to you about the bond market as the fight's going on.
Well, yeah. Do you actually think you're going to offset some of the increase in the deficit?
My goodness, Bramo, never change. Trump's transition team also planning on making a federal framework for full self-driving capabilities a top priority for the Department of Transportation. Any new rules enabling autonomous driving likely to benefit the Tesla CEO Elon Musk, who's currently positioned in Trump's inner circle. That stock this morning, by the way, Anne-Marie up 6.4%.
Right. So this is obviously giving a boost to Tesla, maybe some of these other companies that are looking for this autonomous driving that need the regulation. But federal auto safety standards needs congressional approval. So even though maybe this is an idea that Elon Musk, the first buddy, has decided that he's going to back and he's pushing for, you have to go through Congress. What I think individuals like Elon Musk need to be educated about the U.S. congressional system and the U.S. political system is that there are checks and balances, and everything has a process.
Let's turn to energy. Bank of America's Francisco Blanch looking ahead to next year, writing, quote, the oil market has been pushed and pulled by bullish geopolitical risk and the prospects for a large surplus next year. OPEC Plus faces a difficult challenge, which likely requires continued resolve and possibly additional curtailments if balances deteriorate even further. Francisco's with us around the table. Francisco, good morning.
Good morning.
It's good to see you. Changes then. A new energy secretary potentially in the next year or so. We've got a nomination at least. What are you telling clients about that change and how different things could be under Donald Trump?
Well, there's a number of things that will likely come through out of the new administration, but I think most likely we'll see some of the LNG export permitting come back to the fore. Remember, that was posted under the Biden administration. And that's probably the biggest change. There will be others potentially. There is the Paris Agreement discussion. Will the U.S. pull or not pull out of the Paris Agreement? But I think in terms of the immediate impact on production, remember in America, prices determine how much output producers ultimately pull out of the ground. And I think the biggest risk to prices really is coming from tariffs, right? We have potentially a trade war here, and to me, if the euro keeps, you talked about the euro going to parity, you talked about the Chinese yuan, what's going to happen to it once the tariffs get implemented, if they do. These are downside risks to demand globally, right? America first means commodity second, and I think we kind of start from that point. So look, it doesn't mean we're going to produce more oil and gas for sure, but again, prices will determine that.
So basically, are you saying that we're kind of in a range here and that you kind of see U.S. production as potentially the offset, the potential balancing fact, but ultimately you can't see prices going up too much and frankly, you can't see them going down that much either?
Well, remember, there's also some geopolitical elements to this. There's, of course, the trade war. There's also, of course, there's the potential price war. Remember, OPEC announced they're going to bring production back, which could exacerbate the downside pressure. But there's also the actual military war as well going on, right? We have Israel-Gaza, we have Russia-Ukraine. Whatever happens to those geopolitical events that we're going through right now, I think will also determine the path, right? Remember, under the first Trump administration, we had pretty severe sanctions on Iran, also on Venezuela. We've had Marco Rubio appointed or nominated to be Secretary of State. He's an anti-Iran, anti-Venezuela hawk. So I think that could have an impact. Remember, we are 2.2 million barrels a day above their production levels when Trump left office 4 years ago. So that's one upside risk to the market. But everything else is pointing down.
So I got to be honest, the energy market's been so confusing over the past couple of years. It has been so hard to get a handle on, and it's been basically the Widowmaker trade for a lot of people. I'm just wondering how difficult it has been to get a handle of the supply-demand dynamic at a time where there's increasing use of different renewable energies. There's greater efficiency when it comes to different cars and other vehicles, and you see that in particular with China. How much does that really muddy the picture in understanding what the reaction function is in the market to growth and the potential read-through of some of these geopolitics?
Look, listen, you make a great point. At the beginning of the year, OPEC was coming up with 2.5 million barrels a day of demand growth this year. We're likely going to be under 1 million barrels a day. And a lot of it's coming from, as you pointed out, the Chinese moving to electric vehicles. Now 53% of cars sold in China are EVs. The Chinese, by the way, are exporting 800,000 cars a month. So they got a lot of cars to sell. They're piling up. And then the other thing that's going on is they've moved on a lot of their trucks to LNG, which is 30-40% cheaper than diesel as an energy source. So we've also lost diesel demand. So Chinese demand for diesel is down this year quite a bit. Gasoline demand is flat. And China, remember, has been 50% of demand growth for the last 25 years. So that's why I think we got this trend of, to your point, substitution efficiency, trade war, price war potentially with OPEC trying to get some market share back again. And then there is the actual military conflict that we need to figure out and the sanctions aspect of it.
Francisco, let's pick up on the price war. OPEC Plus, we have seen them put the actual price of oil above market share. You think 2025 that changes?
So in terms of bringing production back on the OPEC side, well, it's going to be a tough call, right? Because they've delayed the increase twice already. And if they increase production, the spot price is going to fall because we have already a surplus coming into next year. There's a fair amount of production from Brazil, from Guyana, from Canada. Even US of A is actually increasing production next year. So if you bring more barrels, the spot price of oil is going to fall vis-a-vis the forward, and inventories would build, which is contrary to what OPEC has stated they want to do. So that, I think, will get us into a price war type scenario. So if OPEC increases production, we think prices could drop another $10 from here, maybe more.
I also wanted to ask you about your first point when it came to tariffs and how that might be a drag on the energy industry. Can it also be a solution? I say that because Ursula von der Leyen called President-elect Donald Trump and said, we still get a lot of Russian LNG. Right. Maybe we'll buy more American LNG. Right. Can that be a solution to some of these potential trade wars?
I mean, 100% is a great point. I think both China and Europe will use their U.S. energy purchases or as bargaining chips in any negotiation on tariffs. So we'll definitely see more purchases on Europe and the U.S. On Europe and China side to try to negotiate a trade regime with the U.S. That's for sure a key part of it.
So just want to finish on this note. If I were sitting next to you at a UFC fight, I would ask you, should I be buying gold right now? Because ultimately, there's a real question about whether the run-up was just a head fake and whether we've seen the wind blown out of the sails, and that's going to be permanent because of how much the dollar's gone up.
Well, so I think in the short run, we think gold could go down to $2,500 an ounce. And part of it is just that those tariffs, the downside risks. We're also seeing interest rates going up in the U.S., right? You talked a little bit about how the Fed may or may not cut now in December. These are important elements for gold because gold was pricing in a pretty steep rate cut path. If that doesn't happen, it's going to be choppy for gold for a bit. Longer term, it's about the budget deficit. Are we ever going to find a solution to this 7% budget deficit we're running on for the last couple of years? And I don't know. I think we have to ask Mike Johnson that question. But I mean, is he going to find a solution?
Yes.
Say yes. All right. So maybe you don't need gold. But I think the point is that, I mean, gold ultimately, if inflation comes back, gold will be a good place to be. So I would say maybe buy the dip in gold, and that'll be probably. I would still think $3,000 an ounce is kind of the target for next year.
25.94 right now, up by 1.2%. Francisco, moral of the story: do not go to a sporting event with Bramo, all right? Francisco Blanch of Bank of America.
Maybe somebody wants to talk about this at a sporting event. You
Ringside.
Don't know.
Debbie Downer.
It's not Debbie Downer.
Absolutely not.
What other people basically, shoot the wind, have a discussion. This is one of those things.
Good stuff, Lisa. Gold's higher. Silver is too. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. In its latest attempt to reset investor relations, CVS Health is adding 4 new members to its board. The additions are part of an agreement with Glenview Capital Management, a hedge fund that's been pushing for changes at CVS. The Glenview CEO, Larry Robbins, will be one of the new board members. Firefighters in New York said that a voluntary evacuation over the weekend helped them protect more than 160 homes from a wildfire near the New Jersey border. The fire was 90% contained on the Passaic County, New Jersey side of the border and about 88% contained in Orange County, New York, where a state of emergency was extended yesterday. The fire's cause remains under investigation. Liberty Energy shares are rising in the pre-market nearly 6%, following news that President-elect Donald Trump has nominated CEO Chris Wright to lead the energy department. Wright, who has no previous D.C. experience, is a vocal advocate for oil and gas development, including fracking. Trump also said in a statement that Wright will serve on the newly created National Energy Council, which will be chaired by Trump's Secretary of the Interior nominee, Doug Burgum. And that's your Bloomberg Brief. John.
Danny, thank you. I, for one, like many others, think it's probably a good idea for the Energy Secretary to have some energy experience, even if they don't have some DC experience. Isn't that a good thing?
That is a good thing. I think most people would agree with you. Also, I think most people voting the way they did want to see outsiders going to Washington, D.C. instead of the Washington complex just feeding into itself.
True. It's a good point. Up next on the programme, the American consumer gearing up for holiday shopping.
There's a lot of moving pieces, and that's why I would say even though we think the consumer's in a better spot, and will be slightly better into next year, it's certainly not a V-shaped recovery by any stretch of the imagination.
That conversation up next. Looking ahead to earnings from Walmart and Target just around the corner. From New York, this is Bloomberg. Let's check out the equity market. Equity futures on the S&P 500 up by 0.1%. We've all been waiting for the same thing, and it finally starts to happen. Some outlooks for 2025. The outlook drops from Mike Wilson over at Morgan Stanley. I was surprised by this one. 6,500, 11% upside. Mike Wilson, Morgan Stanley.
Yeah, you could also drive a truck through the range. I mean, start talking about 4,600 to 7,500. I mean, this is like some of the potential bull cases and bear cases. This highlights how the crystal ball gazing season is particularly muddy at a time of quite a bit of policy uncertainty.
Delayed as well because of the election of the last few weeks, but that's a number on the board. It's a start. We'll get more in the next few days, I'm sure. Under surveillance this morning, the American consumer gearing up for holiday shopping.
There's a lot of moving pieces, and that's why I would say even though we think the consumer's in a better spot and will be slightly better into next year, it's certainly not a V-shaped recovery by any stretch of the imagination. The consumer is willing to spend, but they're very cautious and value-focused, and they want to see newness. And what we've seen from that is Amazon, Walmart, and Costco so far have combined for 70% of retail dollar growth this year.
So here's the latest. Big retailers, including Target and Walmart, reporting earnings this week ahead of a shortened holiday shopping season. Kate McShane of Goldman Sachs writing Target customers are resilient, yet on a budget, while Walmart is well positioned to continue driving solid earnings. Kate joins us now for more. Kate, welcome to the programme. I want to talk about trade just to begin with. How battle-hardened are these companies from the trade war of a few years ago? And how well prepared are they for more of the same?
Yes, I think, frankly, the more discretionary goods you have and more that you're importing from Asia, the harder it is to manage. And so specifically to Target and Walmart, about a third of what Target sells is domestically sourced, so not subject to tariffs. And for Walmart, it's about 2/3 of what they source is domestically produced and not exposed to tariffs. So there is still quite a bit there in terms of exposure. The last time we did see tariffs happen, both Walmart and Target did take prices up. Frankly, most retailers did. And that's probably what will happen this go around as well.
Kate, I have to ask, especially ahead of Walmart coming out tomorrow with earnings, is Walmart still a retail company?
It's a good question. Yes, it absolutely is. But I think a lot of success that they have seen more recently has been with what they call their second P&L or their alternative revenue streams, which is them building out a media business, a fulfillment business, their marketplace, data ventures. And they describe it as an ecosystem, all in which to better serve the customer with. But there certainly is a lot more tech and a lot more to understand from an e-commerce tech standpoint than there's ever been before.
The reason why I ask, Kate, is because we also get TJ Maxx and Target, and I wonder if those are really the cleaner reads on just consumer appetite, the consumer pushback with price increases, those kinds of consumer discretionary trends that people often look to in the likes of, previously anyway, Walmart.
Yes. Well, you still get the true read of what sales are doing in comp store sales trends, which they report every quarter. And we do get color from Target and Walmart about what sales are doing on the consumable side and what sales are doing on the discretionary side. And for all the success Walmart has had this year in terms of growing and taking share, their discretionary still remains somewhat flat. It has not been growing, similarly to Target's.
Kate, do you still see, and I know we talked about this when you joined us in September when this was really one of the storylines in the consumer sector, do you still see individuals on the higher income cohort trading down, this idea of being more choiceful?
We definitely see consumers still being choiceful, absolutely. The trade down hasn't necessarily happened to a degree. I think the story of the consumer is they're employed, and they do have cash. And the Goldman view is that the consumer will stay healthy into 2025 based on how strong the labor market is. I think where we're seeing a little bit of weakness might be at the lower income consumer, just as they continue to deal with higher prices. Prices are still higher than they were a few years ago. But at the mid and higher upper income levels, you are still seeing good demand. It's just, again, using that word choiceful.
Before we get to 2025, I have to get to the holiday season. And I just have to ask, why does Black Friday now feel like an entire week? It was supposed to be just one day.
Yes, it absolutely does feel longer. I would even argue it feels like the whole month of November has turned into Black Friday. And we are contending this year with 5 less shopping days. We have a Thanksgiving that is the latest point in the month that it can be. And there's 5 less shopping days as a result of that. So you're even seeing differences year over year in terms of when you're seeing Black Friday ads and Black Friday deals. But it's all in the name, of course, to engage customers.
Has there been any signs yet? Because I already see the Christmas trees up. I already see the wreaths. I already see, get your holiday deals. So it's basically 2 months, Black Friday, 2 months. I'm just wondering whether we have any early signs of what the appetite has been like for the holiday season.
We don't quite yet, and that's why I think earnings are so important this week for Target and Walmart, because they will have a read into the first couple of weeks of November, and hopefully they will comment there about how sales are going or how they are relative to what we saw in October. So we'll definitely get a better read on that when we speak with them this week. I think data has showed traffic data at the retailers has showed some acceleration into the end of October, early November. So it does look like you're seeing growth in traffic, which is a good sign. But again, we'll get it straight from the company's mouths this week.
Tree went up this weekend.
I knew it would.
I knew that was aimed at me.
I was completely
I felt it. It felt personal,
too.
too.
It was personal.
Saturday afternoon.
Really?
Yeah.
Fully dressed
Looks
or not
beautiful,
yet?
fully
Did you have
dressed.
a panettone as well?
Had a Pandoro, first one of the season.
Nice.
Yeah, ready to go.
I did. I walked by a Whole Foods and I saw all the trees outside, and I saw that the prices were the same this year as they were last year. I thought that was interesting, and I thought Jonathan Farrow right now is putting up his tree.
I'll spare you this conversation, Kate. Thanks for joining us this morning. We appreciate it. Kate McShane there of Goldman Sachs on the latest in retail. Home Depot, a number of years ago. Tree's still doing well.
I know. I was just going to say, yours
TK gives
not.
me hell over the fact that it's fake and it's not real. I used to love a real tree, and now...
Yeah, what happened?
I don't know. I just didn't like going to the street in New York. It just didn't appeal to me.
Carrying it
dropping
through.
$200 on this fake horrible tree, or rather this real horrible tree.
Hold on a second. A fake horrible tree. Is it also the shedding? Does the shedding bother you?
You know me too well, don't you?
It's
the mess.
The
I like
mess,
it clean.
Exactly. It's like
but then you don't get the smell.
Unpredictable.
I know, I miss the smell.
Yeah,
I do miss the smell.
You're going to have to get a bigger candle.
I miss the smell. But the lights are perfectly positioned on the tree.
I'm shocked.
It's
this is my shock
colour
face.
coordinated.
Yeah,
I'll show you a picture in a commercial break, all right? Up next on the programme, Tom Kennedy. We do this every year. Tom Kennedy of JP Morgan, Mandeep Singh of Bloomberg Intelligence. We'll look out for this interview. Carl Bass of Hayman Capital Management, who started this on Twitter over the weekend on X, endorsing Mr. Besson. For Treasury Secretary, Elon Musk responding to him. We'll get his response to the response in the next hour on the programme, and then we'll catch up with the former St. Louis Fed President Jim Bullard on the Fed's path forward. The third hour of Bloomberg Surveillance just around the corner.
Where markets are right now is maybe you could say in the easier phase of the optimism curve when no policy change has yet been implemented. And so kind of all options are still on the table.
When you look at the layers of promises, which would grow the debt, complicated policies like tariffs, this is not going to be an easy situation.
The market is front-running economic announcements.
The reality is you may get a lot more fiscal stimulus before the end of this year.
Policy error probably is our biggest risk, whether it be from the administration or whether it be from the Federal Reserve.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Can we snap the 5-day slide on the Nasdaq 100? Equity futures this morning positive by only 1/3%. Going into the big one this week, earnings from Nvidia on Wednesday. That stock this year higher by 187% after climbing by 238% the year before. It's still flying high. At the moment, though, the focus is on this right here. The race to be the next Treasury Secretary in the United States of America. The list is long. Lutnick, Besson, Kevin Warsh, Mark Rowan, Senator Haggerty. I think there's others as well in the mix still at this point.
So President-elect, according to all my conversations over the weekend, seems to be frustrated by this fight that had broken out between Howard Lutnick and Scott Besson. It was described to me as a knife fight, and this all really centered around Howard Lutnick, the co-chair of the transition, the producer of supposed to be the transition, vetting these individuals, throwing his name into the ring and saying, I actually want that post. So now you see the staff around the president-elect broadening the search, potentially looking at other people. The question I have, is this potentially an off-ramp? Because I do know that people are looking at where else could Howard Lutnick go, maybe an ambassadorship, so that either Scott Besson rises to the top or they actually go with a dark horse candidate. The issue is when it comes to these dark horse candidates, Warsh and also Mark Rowan and Senator Haggerty, where do they stack up when it comes to things like tariffs? Because that is key to other members of Trump's team.
Whether it's coincidence or whether it's related, this has been part of the backdrop for why we've seen, or at the time we have seen, the fade in the performance of equities since the election. What you have seen is a retracement of a lot of it. As you do have this question around policy, and you do have a question around what the reaction function will be in the bond market. And ultimately, my question is, to Henrietta Treyz's point, the markets are heartened to think that they have a role too. They have a seat at the table. Do they actually? Or is that not as important as it has been in the past?
Based on experience, they do. And I thought we saw that time after time. Yes, they put tariffs up, but they backed away every time tensions started to boil over between the United States and China. And we saw that on repeat. As for this race to be the next Treasury Secretary, I'm totally with you. I think this is really important for financial markets. Kyle Bass, who joins us a little bit later this hour, is making the point that it's already starting to dent equity markets. So let's be clear. The S&P 500, the Nasdaq 100, the Russell. Remember the big bullish calls on the small caps? All three trading below the closing level the day after the election.
And the big question here is about sequencing, right? Do you get the tariffs first before you get some of the other implementations? And then also, will there be across-the-board blanket tariffs from the very beginning? Is that the priority for this president, this next president, or is there something else that's on the table?
Here's the lineup this hour. Coming up, Tom Kennedy of JP Morgan as the post-election rally reverses. Kyle Bass of Hayman Capital Management on the fight over Trump's Treasury nomination. And former St. Louis Fed President Jim Bullard on why the Fed is in no hurry to cut. We begin this hour with stocks mixed. U.S. equities are raising more than half of their post-election gains as investors focus on the Fed's next move. Tom Kennedy of JP Morgan staying optimistic, saying we expect policies under the new administration to be pro-growth and continue the era of U.S. exceptionalism, seeing a year-end 2025 S&P 500 outlook of 6,400 and expect U.S. stocks to outperform the rest of the world through next year. Tom joins us now for more. Tom, good morning to you.
Good morning, John.
Let's start with the price action of the last week. Why has this rally started to fade? What's behind that?
We're not drawing too many conclusions from this stalling as we're talking about it here. I think we're still digesting what the possibilities of outcomes could be for the Trump administration. And there are wide-ranging expectations, and so much is in the detail, so much uncertainty. I think what we did need to price was a pro-growth environment where you're going to see deficit spending, deregulation, some offsets from tariffs, but how far can that really go becomes the question. When we stack it up, it looks like a pro-growth environment.
The day after the election, that's what it felt like in the markets too. Just pricing in this positive growth shock. This just drops from Goldman. their year-ahead outlook. They're arguing that the new policies won't change the basic path of the economy. They say this about the Federal Reserve: we expect consecutive rate cuts through Q1 and a slower pace towards the end of the cutting cycle to a terminal rate of 325 to 350. Let's put you on the spot. Why are they wrong?
I don't think they're especially wrong. I think we have in our baseline that the Fed's cutting to 3.5. And in the long run, what drives interest rates is what the Fed does. And the Fed is myopically focused on getting their dual mandate inflation to 2% and the labor market at maximum employment. So I think that's going to be the focus. Will the policies of the Trump administration matter? Certainly. For us, I think it matters more in the sector orientation of the stock market. And this decoupling from China requires an industrial capacity build out that America hasn't seen for a long time. So we now can start to look at the equity market and say, as rates come down, maybe to 3.5 for the Fed funds rate, that should help catalyze some of this capital investment.
So then why isn't your target higher? That's not that big of a gain considering the year-end target that some people have for this year. You're talking about less than 10% gains for next year. Why not kick it up to 7,000?
Well, you're seeing the range on Wall Street as being very wide in certain scenarios, and I think that is validated by the Trump administration. But our baseline of just about 10% total returns from here is above historic averages, despite rates being high, and building on this theme of strength. Today, we're launching our outlook to our clients, calling it Building on Strength. A remarkable 2024 from a macro and markets perspective. Still think you can be more, but you have to temper your optimism and really get focused on the sub-policies that matter. And again, industrial capacity, AI, those are the things that should drive alpha in that market.
I guess the big check has been, and the thing that a lot of people have talked about, is there's real range anxiety. There's yield anxiety. Sort of where are we going to go? Whether we, and Amanda Lyman was talking about this, a disorderly move in Treasury yields. What's that threshold for you when that starts to impede some of the bullish outlook for risk assets?
Yeah, historically, it's just about the speed of the move. And when you saw historically a 2 standard deviation move in 1 month in 10-year Treasury yield, that's when it really mattered for the stock market. Right now, given how much volatility there is, that's about a 75 basis point move in 1 month. It is a lot of movement. Will it matter? Look, we're as worried as anyone about the deficit, but finding the catalyst where it matters is important. I walk around with a big deck like everybody from Wall Street, and it's got 7 or 8 slides on the deficit. Most of them are from my time at the Fed, and I haven't been there for 7 years. So worries can be around for a long time, but at the same time, what do you do about it is the question. A lot of my clients will say, I'm worried. Okay, I can trade you this dollar and take you to Europe. What do they say, John? No, thanks. I'm not interested in that. So we can find this time where investors are really worried, and that's going to be the catalyst. So far, I do see a little bit of change, a little more interest in gold, a little more interest in shortening up duration, but a broad worry that there's a better place to go and save in the world, I don't see it.
You've teed it up. How worried should the rest of the world be?
I think we're all going to worry about this. We'll come back next time. We're going to talk about it again. For the next several years, I don't think this is the catalyst that is going to drive a risk-off move. But it doesn't mean you don't adapt and you don't change. Again, can think about gold, can think about shortening duration, can also think about owning real assets.
More specifically, my question refers to global financial markets. If it's not a problem for the Treasury market, is it a problem for everyone else? Mohamed Al-Erian came on the programme in the last week and said that sucking sound is money coming away from the rest of the world into the United States. When you talk about US exceptionalism, what does it mean for global markets? Who's missing out on that capital, that investment that they could have got, and they're not getting any more?
It's mostly Europe. What you have is decoupling from China and the United States. And what's stuck in the middle is Europe that doesn't have the innovation that America has and doesn't have the manufacturing prowess that China has. That's where I think the sucking sound is. But I think what, referencing your quote from Mohammed, is that that's not deficit woes. That's just the natural progression of deregulation, of deglobalization. So they're two different worries. But as long as money is being sucked out of the world into America, it's really hard to sit here and say the deficit is the bigger worry.
Tom, can you have U.S. exceptionalism when potentially there might be disorderly policy personnel picks? We've seen that with some individuals that are unorthodox, that Trump wants to join his team, and we're unclear on where he's going to land when it comes to Treasury.
Certainly a risk. I think, can you still have exceptionalism? Yes. What underpins exceptionalism is a common law system that we all can agree upon and an independent central bank. I think we need those two things to persist, to really perpetuate exceptionalism and make sure that that sucking sound of capital from the rest of the world into America persists. That's what's necessary.
The good policies that the markets are picking up on, or at least good policies for the markets, deregulation, tax cuts, they have basically 2 years to try to get this done. But what we've seen from these picks so far, when you look at Matt Gaetz for Attorney General, when you look at Bobby Kennedy for HHS, does this basically show that they're wasting time trying to maybe get some unorthodox views through the Senate when they could have been hitting the ground running on these proposals that the market cares about?
Potentially. I think when you look at history of just looking at cabinet members and who's put up, there's almost always someone who's out there and you have to say, there's no way they're going to get pushed through. It's a way to speed up the process beyond that. This is the politics and not necessarily what I do. But is it going to change necessarily the economic landscape of what we have next year and how to think about markets? I don't think so.
Okay, well, to that point, I'm looking at this that you're unleashing today. It's beautiful. People should take a look at how lovely the charts are and your outlook for the year ahead. It's wonderfully and perfectly collated, Was this put together before the election? Did this hinge on the election outcome, or was this basically written before then and then unleashed after just to make sure there weren't any surprises?
Big pieces of this were written before the election because the election is not what's going to drive markets in the long run. But big segments of our 2025 outlook were made after the election where there are policy changes that will matter. Again, incentivizing decoupling from China needs a ton of capital investment in AI, power, infrastructure. Those sections are new post the election. But the big point of this piece is to give our clients a sense of confidence to still invest, stay invested after a historic rally. It has been a monumental last 12 months. We all come on this program and we just get agonized about it. It's a fantastic time to be an investor, and wealth creation. How do you adjust from that too? Different spin on the problems that we do as investors.
Well, so all I can say is people have been coming on the show for quite a while saying you need to get out of cash, get out of cash. Yeah. You're going to need to, you're going to lose you're going to use capital, you're going to lose out in returns. Guess what? We just saw a new record for money market funds at $7 trillion, and people are saying probably more is going to go in just because yields aren't going to be going down that quickly. Do you think that you need that pile of cash to come down in order to achieve some of the gains in risk assets, or is cash and sidelines simply a fiction?
I don't think you need the money to come out of money market funds. And in fact, it generally only happens when rates are getting cut aggressively that money fund cash comes down. What we do need to see is to see the cash that is in the system start to have more movement, see more lending, see more capital that we can actually see M&A and broader financialization continue to happen. That's, I think, going to fuel this growth and return in markets. But deal making is a key piece of our outlook too, that this should still actually come back to market. We should see, even if with higher rates, deal making activity come back. And that's where, to Anne-Marie's point, where deregulation comes into play.
A ton of people watching now might just have one question: market weight or equal weight? If I want to get some exposure to the S&P 500, what's the best way of doing it for the next year?
Equal weight is our outlook call for next year. And you made a good point. Like the broadening in small and mid cap was a big call this year. We had that call on in 2024. That was incorrect. Until recently did you see some broadening out. But the broader look back on the year is that we should have been optimistic. We came into the year 2024 more optimistic than consensus. We were not even close. I mean, it's just such a remarkable phase of what we do. Still think there's more strength ahead in our outlook, building on strength.
It's worth remembering as we look ahead to next year that if you look back last year to the 12 months forward, this is not the year people were looking for in any way, shape or form. 20% gains on the S&P, they would have been laughed out of this room.
Yeah, also big tech dominance, once again, that also would have been laughed out of the room. Also, no recession anywhere in sight, that also would have been laughed out of the room. There's so many aspects of this that have been hard to gauge.
Also, how many Fed cuts were we supposed to have in 2024?
7 or 8.
15.
Was it 15?
No, I'm kidding.
I forget because we repriced it 3 different times in the first quarter.
It was
Tom,
never
it's good
15.
to see you. And then we got that inflation head fake, which turned out to be a head fake. Then they started getting worried about the employment situation. And then we had the Jackson Hole speech. I mean, we've gone back and forth a million times. Tom Kennedy of JP Morgan. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President-elect Donald Trump's transition team told advisors that they plan to create a federal framework for full self-driving vehicles, clearing the way for mass adoptions. People familiar say the talks are still in the early stages. It is, though, welcome news to one of Trump's closest advisors, Elon Musk, who has promised that Tesla's self-driving cars will go into production before 2027. After gold's record-breaking year, Goldman Sachs predicts more upside in 2025. The firm reiterated a target for gold to hit $3,000 per ounce by December of next year. The strategist cited demand from central banks and Fed rate cuts. Gold is one of the firm's top commodity trades for 2025. Average U.S. gasoline prices are set to fall below $3 a gallon and already just a few cents above the lowest level since 2021. That dropped just in time for Thanksgiving, where holiday travel is expected to climb back to pre-pandemic levels. 71.1 million people are expected to drive by car for at least 50 miles in the 7 days around Thanksgiving. That is the most since before the pandemic. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next, the morning calls. Plus, Mandeep Singh of Bloomberg Intelligence looking ahead to the big one later this week. Earnings from Nvidia. That stock is down in the pre-market by 3%. Outlook season is finally upon us. 6,500 over at Morgan Stanley year-end 2025. We just heard from JP Morgan's private bank. 6,400 on the S&P. Equities right now just about unchanged. Let's get you some morning calls. First up, HSBC upgrading Moderna to buy, saying the company is failing to properly value the company's pipeline. The stock is up by 2%. In pre-market trading. Your second call from Needham, upgrading Robinhood to buy with a $40 price target, expecting shares to benefit from a Donald Trump presidency. The stock is up by 0.9%. And finally, Barclays raising its price target on Tesla up to $270, seeing attractive policy changes for autonomous vehicle efforts. The stock's up by 6% in the pre-market. Let's turn to Nvidia. The information reporting the chip maker is facing a design snag for its advanced Blackwell chips. That report sending shares lower ahead of its highly anticipated earnings on Wednesday. The stock is down by 3%. Mandeep Singh joins us now for more. Mandeep, welcome to the show, sir. Let's get to Wednesday when we get those earnings from Nvidia after the closing bell. What's top of mind for you?
Well, so everything that we have heard so far this earnings season from the hyperscalers has been very constructive in terms of, raising the CapEx, model scaling laws still holding up. So that should translate into a significant beat and raise for NVIDIA, as we have seen in the past 6 quarters. Now, with the change in administration, I think it's a positive for NVIDIA in the sense that they are exposed to crypto and autonomous driving with Elon Musk's, involvement in the administration. So that should actually expand the addressable market for NVIDIA. So net, I think we are in a much better spot when it comes to NVIDIA visibility now than we were 90 days back. And hopefully that should translate into quite a bit of a beat and raise this quarter.
Mandeep, that might be going forward in terms of the policy shift and what might be the backdrop. But I just wonder, the beat and raise, I want to dig a little bit deeper into where it comes from. How much is it from the hyperscalers? Is it from the Googles? Is it the Microsofts? Or is it starting to broaden out? Do we need to see that broadening out in order for NVIDIA to keep its gains?
Well, so you're right. I mean, NVIDIA has a 40% plus revenue exposure to the 4 hyperscalers. And what each of them said, and I would quote, Sundar Pichai saying 25% of the new code is written by AI now, and Mark Zuckerberg saying Meta Llama will be 10 times bigger, the next version of the model. Those are 2 very constructive data points when it comes to the overall market. And that is what gives everyone the optimism and visibility going into 2025. Now, still there are concerns about the 2026 number because the field of the companies that are training their large language models is narrowing. No one has the capex that these 4 companies have. And even if Apple and Tesla are 2 of the incremental players, you still can see 6 or 7 companies focusing on model training. But concentration is never good. At the same time, I think the scaling laws, as long as they hold, it's a big boost for a company like NVIDIA.
When did the hyperscalers really reach the limit and how much they can expand in the United States? And I ask this because we start talking about policy mix. And there's a real question mark around national security and expanding some of those data centers overseas at a time where there have been restrictions on certain AI chips. And ultimately, those data centers in other countries could be considered exports of chips. At what point does that become a headwind to the likes of NVIDIA?
Absolutely. I mean, that is a concern given, there is so much sensitivity around the training of these LLMs. And look, Elon Musk just set up a data center in Memphis where he has a cluster of 100,000 GPUs. That was built in a span of 20 days. Now, the question is, if the scaling laws were to hold, even a 100K cluster isn't enough. There will be a 200K cluster. Do we have enough power in the US to supply that kind of data center? That is what seems to be the bottleneck, the power aspect of it. Now, I think it's the same outside the US as well. But as long as, we keep talking about NVIDIA benefiting from more clusters, more chip demand, do we have sufficient power to pull up that kind of data center right now? And I think that's where there still is some uncertainty whether we have that sort of power availability.
Mandeep, NVIDIA's huge, so we've all got exposure to it in one way or another. Can you help explain this story this morning? From The Information, reporting that the chip maker is facing a design snag for the Blackwell chips. Just what is going on with them? Because we see that dropping in and out of the news repeatedly and shaking up this stock from time to time.
Yes, I mean, it happened, I would say 2 months back. The stock reacted negatively after earnings, but it's run up almost 40% since then. And the reason why investors remain optimistic about NVIDIA is because even if there are delays, those companies that are training their models have nowhere else to go. It's not as if NVIDIA is doing any better in terms of the training chips or Intel is doing any better. So still, NVIDIA is the only game in town. Even if that gets delayed by 3 months, so what? The companies will wait for it. So I think from that perspective, I don't worry about the delays or the snags that much because NVIDIA is so far ahead when it comes to the GPUs that they have developed versus everyone else right now.
Can we look at the 5-year performance of NVIDIA? 2,575%. That graphic is ridiculous. Mandeep, thank you, sir. Mandeep Singh of Bloomberg Intelligence. It's so big now. Reminds me of this note from Torsten Slok of Apollo from a number of months ago, a number of weeks ago, when he said this. It's now bigger than the total market cap of 5 of the G7 countries. Foreigners own 18% of the US stock market. The bottom line is that global equity markets, including retirement allocations to equities, are basically leveraged to NVIDIA.
Well, Jim Reed, actually, of Deutsche Bank this morning came out with a similar point, basically saying this $3.5 trillion market cap company accounts for the entire FTSE, DAX, and CAC, and has a market cap of all of these countries. So basically, it's like a whole G7 countries stock market, all of them reporting at one time.
On Wednesday.
After
the closing bell. NVIDIA, stay tuned for that. We talk about the Federal Reserve all the time. Chairman Powell and his big power that he has over financial markets. Gilles Moec has just as much sometimes on the equity market.
Yeah, and can you get some of the inverse reaction? I mean, what we have seen actually in recent earnings periods is the reaction in NVIDIA stock is actually the opposite of other stocks in the equity market. Does the rest of the equity market matter? We were talking about how wrong we all were about our different outlooks for this year. And let me tell you, I'm wrong every year, but I'm especially wrong this year. Not that I have an outlook. But anyway, let's move on. Really, the biggest question was how much big tech could continue gaining. And guess what? They were the leaders again. And can they continue to be in 2025?
It is always difficult to put out an outlook. I think we should acknowledge it's even harder this time around to put out an outlook. Still waiting to see who the Treasury Secretary might be. Up next on the programme, do not miss this conversation. Carl Bass of Hayman Capital Management on the race to be Trump's next Treasury Secretary and the little spat that played out over X over the weekend. Equity futures on the S&P 500 negative here by 0.1%. In the bond market, yields are higher by close to 5 basis points now on a 10-year. We're having another little look at 450, 448.69. $60 minutes away from the opening bell. Equity futures here on the S&P 500 slightly softer. We're down 0.1% on the Nasdaq, still higher, but way off session highs. We're positive by 0.05%. With your morning movers, here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. I know you spent a little bit of time digging into the narrative around NVIDIA, but it is a drag on these markets this morning. And you need to reflect. Everybody's trying to game out what Trump 2 might look like for big tech. Back in 2018, the stock crashed by 30%. That was the first sort of shock that came through. But their global dependency, 57% of the revenue for NVIDIA is on a global perspective. So tariffs may well matter, and the relationship with China will matter. China's gone from being 25% of their business in 2021 to 12% of their business. So what new headwinds may well come? Fast money's taking a little bit off. You hear that word that Blackwell may have some problems around overheating on the racks, and fast money goes straight in, takes it down, but it's had a hell of a ramp. Tesla, politics matters, access matters. Nice headline on the Bloomberg this morning that the Trump team may well look at easing the US rules for self-driving vehicles. Again, this just invokes a new rampage to the upside. This is about invoking change at the Transport Department, invoking change around a whole host of administrations. That is the narrative. Of course, they don't have a self-driving car just yet. We had the robo-taxi and the stock was down 10% the day after. Liberty Energy, you're just about to delve into the various narratives around who's heading what. Chris Wright, Tap for Energy Secretary. He's got absolute knowledge of fracking, and this is somebody who's worked in nuclear, solar, geothermal, but this is his stock ramping higher. The question is, how will he manage the OPEC Plus relationship? Where is he in terms of renewables? Because he has got history and form in that area. Jonathan.
That's a man who knows his stuff. Manus Cranny. Thank you, sir. Let's turn to politics. A battle royale playing out in Palm Beach, Florida, as the infighting over Donald Trump's Treasury pick continues. Kyle Bass taking to X to advocate for Scott Bessent, calling him, quote, eminently more qualified than Howard Lutnick. Tesla CEO Elon Musk responding, quote, Bessent is business as usual, whereas Lutnick will actually enact change. Joining us now to discuss the man himself, Kyle Bass of Hayman Capital Management. Kyle, my friend, welcome to the program. Let's start with your message and your disagreement, I would say, with Elon Musk. Elon Musk making the point that Bessent is business as usual. We know Bessent, you know Bessent. Kyle, why is he wrong?
You know, Elon, I'm not sure if Elon had ever spoken to Bessent before he made that comment. And I think it's important to understand who Scott Bessent is. Scott, was the chief investment officer for the Soros organization for a long period of time. And I know for some people, that sounds like a negative if you're talking partisan politics. But I think it's important to note that global central bankers around the world have respect for Bessent and his views. Scott looks at the world, with a 4D chess overlay, meaning he understands geopolitics, he understands people, he understands exactly what investment flows and economic flows matter and don't matter. So when you get into talking about tariffs, you get into talking about the bond markets, which we've had a pretty steep rise in our 10-year rate just in the last couple of months, almost 100 basis points. I think that's a worrying sign. And I think you need someone in this seat that understands geopolitics. We have a ground war in Europe. We have Israel, Iran. We're about to have China, Taiwan. And if you've got someone like Scott in there with that global expertise, who has been an investor in global macro events all around the world for decades, I look at the list of potential nominees, and the person that is correct for the United States of America, correct for the Trump organization, is Scott Bessent.
Kyle, you said that Elon Musk and Scott Bessent, you don't think, spoke before that tweet. Sources have told me they did have a conversation after this spat has played out on Twitter, with Elon Musk responding to your tweet. But how much is this about tariffs, about the fact that maybe Scott Bessent will be a little bit more judicious when it comes to tariffs? And I'm hearing, and reported last night, that they're even considering someone like Peter Navarro, a trade skeptic, tariff lover, to put at the top role in the West Wing at NEC.
I mean, look, I'm sorry for smiling, but I think the tariffs that got put in the first place, the 232s and 301s, if you remember, the Biden administration campaigned on the fact that they were going to immediately remove those tariffs. And Emery, notice they're still in place. When you have state actors acting non-economically like China does, if they want to put our steel business out of business, they can export steel and dump it into our marketplace and take capacity utilization below our break-even point, and they can bankrupt an entire business. So when you're looking at this, forget it for a second with an economic lens. Forget about growing the economy. There are two jobs here. One is to protect the national security of our country. The other is to grow the economy the best you can while protecting our national security. So when you look at the tariffs that were put into place, those were not broad brush, we're going to show China that we're strong and they're weak. This was us protecting our steel and aluminum businesses very specifically from the threat of the Chinese government putting us out of business. So we know that we have global supply chain deficiencies. We know that all the synthetic graphite is made in China. We know that all the industrial abrasives are made in China. We know that our APIs for our antibiotics are made in China. We have to unwind that dependency there, and we have to start thinking with a national security lens. And I think when you look at the candidates here, some are domestic folks that have focused on domestic policy for a long time or domestic business. Others, there's really only one. Scott Bessent is the one who understands the way global trade flows work, and he also understands national security.
Well, let's talk about some of the other names as well. New York Times has followed some of the reporting me, Josh Green, Saleha Mohsin have done regarding the expanded list. There's Kevin Warsh, there's Apollo's Mark Rowan, there's also Senator Hagerty, and there's Robert Lighthizer. What do you make of those other names? I think a lot of people would push back that Mark Rowan doesn't understand how global financial markets work.
Yeah, I wouldn't make that comment. I would just say that, to become Treasury Secretary, you have to divest your holdings. I think Mark Rowan's divestiture would be pretty difficult. I don't know Mark, but I have friends that know him and think very highly of him. Lighthizer has been an amazing U.S. trade rep in the past. He is, and I've read a lot of his testimony when he testifies before Congress and the Senate. He is a very thoughtful person, and he's the architect of the 301 and 232 tariffs under the last Trump organization, but is someone that focuses only on tariffs, the right person for the single most important financial job other than the Fed president in the United States? I doubt it. So I look at all of these other candidates, and again, Scott rises to the top no matter who we're talking about so far.
Kyle, whether it's on X or whether it's right now, you really are backing this individual, Scott Bessent. So we have to ask, how much is this maybe a personal preference to your market positions?
Oh, I mean, I only have one market position in the public markets. I've been short the Hong Kong dollar since 2017. That just doesn't matter. And I say that meaning China, Xi Jinping has told you since 2017 that he's going to take Taiwan by force if necessary. When that happens, I think you see global linkages break. So that's not up to whichever candidates in our Treasury. That's up to Xi Jinping himself. So my market positions have no impact on who I'm pushing.
It raises a question, though, Kyle, of whether we understand the market read-through from one of these candidates and whether the market response will actually be a check on who gets selected to be Treasury Secretary. Do you believe that President-elect Donald Trump would like somebody who would be good for market, or at least for markets to keep going up?
Yeah, of course. I mean, what I'm talking about is who's best to grow our economy and also to protect our economy from state actors that say have malign intentions. And so you have to think about people that have that kind of experience, the kind of experience to understand who the malign actors are and who the good actors are, but also how do you grow, given the cards you're dealt, how do you grow your economy? The U.S. has become a regulatory superpower. The Trump organization's first moves are going to be reappoint heads of key agencies across the board. And I think you're going to see the animal spirits unleashed from let's say, the penalty box that they've been put in, basically by Lena Khan's FTC. And we're going to go back to old antitrust law, real antitrust law. We're going to go back to business combinations. We're going to go back to U.S. Entrepreneurship. And we're going to see the economy really grow in a place that we've seen hamstrung by the prior administration. So, yes, Trump wants someone in there that's going to continue to move stocks higher. Yes, Trump wants someone in there to focus on the worrying trends in the bond market. We are still running north of $1 trillion deficits if you look at the CBO estimates, and we're going to run, I don't know what the number is, $1.4 trillion, $1.5 trillion this year, maybe more. And so we've got a lot of bonds to sell going forward. And you've got China's economy circling the drain. All you see in China is stimulus. And if you remember the beginning of stimulus, you're just filling a hole. The Chinese banking system is at least $2 trillion in the hole. So their stimulus has done nothing but stabilize their market with regard to investors' sentiment. But you haven't seen any real stimulus there yet. So it's going to be difficult. We're not going to see inflows from China into the U.S. stock market. We're not going to see a lot of inflows from Japan because Japan has its own problems. And we've got a lot of bonds to sell. So who we put in as Treasury Secretary is going to be vital to the stock markets, the bond markets, and our prosperity. And again, I believe there's one candidate that understands all of that. And yes, I've known him for a long time. And it's why my confidence is so high in his ability to operate in this current environment.
Kyle, let's just finish where we started. That original tweet of yours over the weekend implied that you believe the uncertainty around this pick now is starting to have an impact on financial markets. Where do you see that playing out more acutely?
Yeah, I mean, look at the bond market. Look at the worrying trend in the 10-year. The 10-year is almost up 100 basis points. When Trump got elected, the animal spirits in the markets took off. We all saw what happened in equities and credit and even in cryptocurrencies. And now you've seen that tempered because now the markets don't have a great handle on who's going to be Treasury Secretary. Nothing's monocausal, but the markets were discounting a Scott Bessent win. And now these other names are kind of elbowing their way in to a potential nomination, and that's what's giving the markets pause. So I think the markets were discounting Scott's position, and now the markets are pulling back, wondering who else might be put in the position.
Interesting. Carl, appreciate your time, sir. Thank you very much for being with us. Carl Bass there of Hayman Capital Management on who he wants in that seat. Plenty of other reasons to suggest why we're seeing these moves in the bond market over the last week. That's one suggestion from Carl as to why he thinks we're seeing these moves.
That there might be somebody who isn't necessarily paying attention to the offset of some of the increases in deficits that other people are mapping out. Also, the idea of how much we've seen a retracement in equity prices. A key question, though, still, and I think that the sort of discussion with Kyle Bass and Henrietta Treyz bookend this well. Just how much of a check does this market have on the policies coming from President-elect Donald Trump?
Couldn't agree more. One reason we've seen this move in the bond market over the last week is not just about what's playing out down in Palm Beach, Florida. It's about the Federal Reserve. Investors dialing back December rate cut bets with plenty of Fed speak still to come this week. We can catch up now with the former St. Louis Fed President, Jim Bullard, for more. Jim, welcome back to the programme, sir. So much has taken place since this election. We've heard from the chairman, Jay Powell. Jay Powell suggesting to us that maybe they can pause if they want to. This is me inferring from what he's told us already, maybe as soon as December. Is that what you're taking away from recent communication?
Yeah, I mean, if it was me, I think they could make one more move here in December, and then that would put them at 4 3/8. And then there'll be a debate about where neutral is. But if you thought the median of the committee thinks neutral is maybe 3%, then you have to have maybe 100 basis points on top of that, because, or 125 even, because inflation isn't all the way back down to target. So normally you would take the inflation difference and then multiply that by 1.25 or 1.5 or something like that, and that's what a Taylor rule would do. That's going to put you right around 4%. So they'd actually be pretty close to where they'd want to be. They'd have another move to make maybe in the first quarter or second quarter. And then after that, it would depend on where inflation went during 2025. So they're in pretty good shape here, I think, for the December meeting.
Jim, maybe for December, but moving beyond that, there's a real question. I haven't heard a lot about long and variable lags in a long time. And basically, there's this feeling that maybe if markets are flying and we have this feeling that businesses are doing just fine, that everything can chug along at these interest rates. And you alluded to it. We could see a higher neutral rate. Just how much have you heard a change in tone from Fed officials over the past couple of weeks?
Yeah, well, they've made 75 basis points of cuts already, so they're not in the same situation that they were in, say, June or July. And I think the growth scare that occurred in sort of the July-August timeframe has dissipated, and now you've got GDP now, Atlanta Fed at 2.5, and the last 2 quarters of growth have been pretty strong, certainly above potential growth rate for the U.S. economy. And so I think, they don't have to go too much further to be at the right rate for this level of inflation and an economy that's, moving along pretty well. Retail sales, reasonably good yesterday.
So given all of that, I'm trying to extrapolate this out to understand what this means at the long end, what this means for the yield curve at a time when suddenly people are rethinking just how much they can cut over a longer period of time. You add to this some of the pro-growth policies that we've been talking about all morning. How much are you looking at bond yields resetting, not necessarily because of the political overlay, but because people are realizing that if it's a 4% neutral rate, a 5% 10-year yield looks pretty reasonable?
Yeah, I mean, to me, this is the last piece of the soft landing. You're bringing the policy rate down to a more neutral level as inflation goes back to target. And you would expect the yield curve to uninvert, which has happened here. And I thought that, eventually you'd have the policy rate somewhere in the 3s and the 10-year somewhere in the 4s, and you'd have this nice upward sloping yield curve. So that all seems to be developing. And that's part of the soft landing narrative, in my view.
When we heard from Jay Powell and the fact that he's talking about they're not in a hurry, how much does that have to do with policy uncertainty that right now is coming out of Mar-a-Lago, but will be coming out of Washington, D.C. for 2025?
Yeah, I think the sense of not being in a hurry, if you think about this December meeting that's coming up, there'll be a summary of economic projections at that meeting. And what the committee will do is various members will project out for 2025 and 2026 how many more rate cuts they think. But it's not going to be that many, right? Because they've already made some, and neutral won't be as far away as it was. And so then they'll say, well, some people say I only need 2 more, or other people say I need 4 more or something, but they'll spread those out over 2025 and maybe even over 2026 as inflation is projected to continue to come down. So in that sense, it will smooth out, and people start talking about, well, maybe once a quarter, maybe once every third meeting or something like that would be the right pace, depending on how fast you think inflation is actually going to go down to 2%.
Right. So you're talking about inflation coming down to 2%, but some of these policies could be inflationary. We're talking about deregulation. We're talking about cutting taxes. And then there's this debate on how high the walls are going to go up around the United States for imports coming from China or the European Union. If that's the scenario we have, does the Fed need to think about potentially hiking?
I think we've seen this movie before in 2018, 2019. I didn't see much inflation coming from that. We had a corporate tax cut late 2017. I didn't see much inflation from that. So I don't think that that's the right narrative for this. That's not where the inflation is going to come from. Where it comes from is big fiscal spending, but if it goes straight into people's bank accounts the way it did in 2021, that's almost like printing money, and that ended up causing a lot of inflation. But if we don't get something like that, and I haven't heard anybody talking about that, then I think other types of spending are probably not, deficit spending, probably not as inflationary.
Jim, that's a fascinating point, and it really goes to the heart of something that I've seen explored in a number of research papers over the past few weeks, which is how we don't understand inflation, why the Fed got it wrong and didn't raise rates as early as March of 2022 in the face of real inflation, and going forward, our understanding of what the read-through will be from things like tariffs. Are you basically saying that some of the tariffs that we're hearing about are not going to be inflationary, and that, frankly, we should be looking simply at a cash infusion, at helicopter money, as the only source right now of the inflation that we've seen in the post-pandemic era?
I mean, inflation is a monetary phenomenon. That's why they call it monetary policy. And it's the job of the Fed, especially, to keep inflation expectations under control. So you could argue about an inflation expectations channel here if people start to worry that the Fed's not going to do its job. That would be a serious concern, I think, for the inflation outlook. But tariffs themselves, kind of a double-edged sword. They rearrange the prices somewhat, but they also change demand for the imported good. And you've also got what's the reaction of the foreign country going to be. So a good outcome would be is that you get serious here and you tell the rest of the world, which is pretty protectionist, We tell the rest of the world, the U.S. is going to play tougher here, and we want you guys to lower your tariffs. And those guys could say, hey, well, we agree, and we're going to lower our tariffs. So you get just a lower tariff environment out of the whole thing. That would be very consistent with sort of the Trump negotiating sort of view of the world.
Jim, we won't ask you for your favourite Trump Treasury Secretary. We'll let you go. Former St. Louis Fed President Jim Bullard. Jim, appreciate your time, sir. Thank you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President-elect Donald Trump has chosen Brendan Carr as his next FCC chair. Carr is currently serving on the commission and has served at the agency since 2012. In a statement after Trump's victory, Carr said his priorities include having a, quote, important role to play in reining in big tech. The FCC, of course, does not directly regulate tech, but it does oversee parts of the sector like broadband access and net neutrality. New York City transit officials are voting today on a revised congestion pricing proposal. The plan would charge drivers $9 to drive into large sections of Manhattan starting in January, and then increase to $15 by 2031. The initiative will still provide the city's transit system with the $15 billion it needs to upgrade its more than 100-year-old infrastructure. Officials then are seeking to start the fee on January 5th. Netflix has announced that Beyoncé will perform during its first ever NFL Christmas game day matchup between the Houston Texans and the Baltimore Ravens. Netflix is using the opportunity to put on a Super Bowl-style show, with this marking the first time Beyoncé will perform songs from her Grammy-nominated album Cowboy Carter Live. Netflix made a 2-year deal with the NFL for Christmas telecasts in 2025 and 26. And that's your brief, John.
Danny, thanks for this morning. Up next on the programme, we'll set you up for the week ahead. A ton of earnings, including results from Nvidia. The opening about 35 minutes away. Your trading diary looks like this. Tomorrow, earnings from Walmart and Lowe's. Wednesday, Target and Nvidia out with results, plus some Fed speak from Cook and Bowman. Thursday, jobless claims and more Fed speak from Austin Goolsbee. And finally on Friday, PMIs and UMich sentiment. Final word around the table. Bramo.
We could finally make earnings great again, because ultimately I think that the politics is not fading, and it's not going to fade for a long time. But people are focused very much on whether we are seeing growth and acceleration in the earnings to figure out whether there's going to be another leg up, or whether it's bond yields or whether it's in the equity market.
Well, I'm gearing up for another episode of Game of Thrones to figure out.
It's been quite entertaining so far.
It's been quite entertaining. I have to say I didn't actually take any days off this weekend. I was working the entire weekend. And the fact of the matter is, I just want to know, and you said it earlier, this Dick Cheney move by Howard Lutnick, does it spoil the chances for Scott Bessent? Do we see a dark horse candidate really rise to the top now?
I think we're all on the same page. Whoever gets the nod will go some way for many people in this market for defining for them how sensitive the Trump second term will be to equity markets. Equity futures right now positive by around about 0.1%. Coming up tomorrow, Russ Kostrick of BlackRock, Senator Bill Hagerty of Tennessee, reportedly in the running for that seat, Emily Rodland of John Hancock, and Lara Rame of FS Investments. Big show coming up tomorrow morning. Looking forward to covering it with you. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.